alongside commodities as well. I'll give you some movers to the downside. Novo Nordisk, AstraZeneca, Sanofi, GSK. In terms of index contribution or index weight to the stock 600, that's where your pain lies. A little bit of a bright spot, though, in utilities here. You are seeing that sector higher by about 0.1%, Anna, but broadly red across the board.
Yeah, absolutely. It's a very red. It's a very red experience looking at the stock 600 this morning. And we are selling those sectors that we flagged earlier. So healthcare, as you say, Chrissy, is under pressure. Auto is also under pressure, and these are very much linked to news flow coming out of the United States, to either appointments or other reports around regulation or subsidies. So that's really fascinating to see. But also technology is a bad performer today, the worst performer, in fact, across European equity markets. And that may be just a reflection of how far it travelled north yesterday, but that was the best performing sector today. We see some of those chip names under pressure today, ST Micro, ASML, for example.
What is interesting is you are getting a bounce back in some of the renewable sectors.
Yeah.
So Vestas is coming back, Ørsted's coming back this morning. Some of the defence stocks are also a little bit higher as well. Not enough to obviously offset the losses that we're seeing in names like ASML, Novo Nordisk, some real heavyweights that are moving on the downside. It is the big vaccine makers that are certainly suffering, but it's broad-based. Like the pharma sector is down broadly on the back of this. Novo, Sanofi, Roche, AstraZeneca, Novartis in terms of the points drop that we are seeing. So it's not just the vaccine makers, it's the pharma sector that is under pressure here as well. But some of the winners recently, Schneider's having a less good day. But Anna made the points earlier. Generali, the biggest points gainer here in Europe this morning.
And I should say, buried in all that, ASML as well, adding to the points
down
as well.
That's the biggest points loser.
Yeah, exactly. So not such a great picture for Europe. So the question is, where do you actually buy? And how much of Europe is taking the lead from really what's happening over in the States? Morgan Stanley Chief U.S. Equity Strategist Mike Wilson spoke to us about his year-end target for the S&P. Take a listen.
We could probably trade 6,100 probably before year end, so we're right there. Could we get higher than that in the near term? I think it's going to be hard, but yeah, we're marching higher. Finally, after 2 years, we're finally starting to see a broadening out in the broader economy, and that translates into better stock performance for the average stocks.
Joining us now, Chris Watling, CEO and Chief Market Strategist over at Longview Economics. Joining us around the table this morning. Good morning.
Good morning.
Let's talk a little bit about this divergence between Europe and the United States. Buy the U.S., sell Europe seems to be the trade in vogue. How long does that last?
I don't think it lasts too long. I mean, I think there's sort of a bit of post-election surge on the back of the Trump clean sweep, which is clearly a very pro-growth agenda, with the one caveat on tariffs, of course, which is an important caveat. And I think that Europe's taking a bit of hit on that. But I think as to what we just heard on the clip, the market participation should broaden. I feel cyclically the global economy should be re-accelerating quite nicely into next year, and that will change the way stock market sectors behave and where the leadership is. So the leadership, as we know, up until the middle of this year was very much narrow Mag 7 and so on. But I think, and that's of course because most of the West was stagnating for a couple of years. But I think as we deliver this cyclical impetus, as we cut rates, as we get more fiscal stimulus, cyclical global economy in the West is going to reaccelerate, and global stock market participation is going to broaden away from the Mag 7. In fact, the market's already trying to think about that. Other than absent, these overnight sort of news flow, healthcare, pharma, which I think is fascinating. I think there's more to it than just vaccines, by the way. It's much more complex than that, the appointment of Bobby Kennedy. But yeah, I think the market's broadening, and cyclically the global economy looks really good for next year.
The idea, though, of this Mag 7, this concentration risk of this breadth, some would argue will kind of already have that dynamic that exists in the stock 600. Guy loves to look at the core 6, the sensational 6, or even the granolas, you name it. This idea here that the breadth, the concentration risk isn't a risk in Europe, could that be a bull case to invest here?
Well, there's undoubtedly, the sort of granolas in Europe were caught up with the Mag 7 idea. There was definitely a move to the large cap stocks around the world, the mega caps over the last year or two, sure, almost as a defensive play. But look, mid caps, small caps, pick your country. S&P 400, S&P 600, UK FTSE 250. Domestic plays on Western cyclical recoveries are very attractive. They're cheap areas of the market. And they're parts of the large cap sector that haven't been caught up in this trade in the last couple of years that are interesting.
So I want to go down the cap scale.
Go down the cap scale. Yeah, they're basically...
That's a valuation argument, right?
Yeah, it is essentially a valuation argument. And it's not a valuation argument, it's a broadening argument that happens. What's done well is expensive.
Okay, yeah. So what's done well is expensive?
Yes.
How expensive?
absurdly expensive in many ways. Absolutely. I always say valuation is never a good market timing tool, as we were discussing beforehand, and you can prove that in a million ways. But it is expensive, and the cheap stuff, put it this way, we've got this sort of thing called the hidden gems. There's 4 country stock markets around the world that are less than 50% the valuation of the US that had faster earnings growth over the last 3 or 4 years. Well, a couple of them a bit obscure. So Hungary and Poland, and Greece is vaguely obscure, and then Italy. All of these countries are growing earnings faster than the States.
Right.
And, no one's in them. No one's owned them forever. But they're doing very well. Italy's doing very well. Greece is doing well. I like Spain. I think it's a really interesting country. These are places no one's talked about for 15 years. And they are back.
Yeah, do you watch this show? I
Sorry, apologies. You and me. It's just you and me.
There you go. United
against the world.
United
and the Spanish,
the Iberian Peninsula. What about Trump's tariffs? Sorry to rain on the European parade, but what about Trump's tariffs and where that might be for Northern Europe much more of an issue, or not?
Well, firstly, we think there's a switch of growth leadership in Europe from the north to the south.
Yes.
And agreed, Northern Europe's more of a trading powerhouse. But I think Trump's tariff is the big risk in all of this. And of course, we, the market, none of us really know whether it's day one, bang, the whole lot, or day one, we'll do a bit on China, we're going to negotiate. No one knows. The market doesn't know. And to be honest, the currency's already moved a lot. That was the one thing that looked certain over the course of October. Trump was going to win the presidency. We didn't think he'd get a clean sweep. And the market priced in the tariffs risk. That's why the dollar rallied. So I think a lot of it's in the price. It's not good. It's disruptive. But, I don't think it's enough to throw this whole thing off.
Are we going to end up in a sort of tariffs arms race, do you think? Is that the assumption? Do you assume that if Trump puts on tariffs that other countries respond? Because we heard from Andrew Bailey overnight urging countries not to respond in that way. But politically, is that going to fly? We've already talked about Harley Davidsons and Levi jeans when it comes to Europe getting its own back on the US.
Chris's 2 favourite things.
Chris's weekend. I just described Chris's weekend.
None of the above, actually. I know, I must look like that. No, I think the Europeans are a bit. There'll be some tit for tat, but I think it'll be measured.
So that,
it's not like no one's dealt with Trump before.
Really, for the valuations and for
it does matter. It is important. It's not helpful. It's not a good thing. But actually, most studies show most of the effect falls on America, not on Europe. So, there's a lot to think about. I mean, there's a lot going on. China, of course, is a huge issue. Germany's a huge issue. They're both big global traders. But, China's stimulating. They're going to keep going. So I just think the stimulation probably overwhelms everything else.
But
we will see.
Is there a complacency to that? I mean, it just feels like when you look at this market reaction, they do stimulate, and they do try to get that, and it lasts for about 2 minutes, and then it goes right back down. I'm just wondering how much tolerance is there for that? Is stimulative policy still stimulative?
Yeah, I think it is, absolutely. It's just a question of degree, and it's a question of what you're doing and where you're doing it. I thought what Rachel Reeves said last night was the first decent thing I've heard her say, that we're going to de-risk regulation. Okay. Fantastic. Get regulators to go for growth. The problem with Britain is we over-regulate and we discourage risk-taking. It's not complicated, is it? We live in markets. You take risks, you get a return. It's the same in the economy. You take risks, you get a return. If you sanitize everything, you don't get returns. So that's good. And Trump is going to deregulate the banking system. Great. That's good for risk. All of this stuff. Shrinking government. Please, let's have it here. Great that they're going to do that in America.
So UK pension funds should buy fewer gilts and buy more stocks?
They certainly should, yeah. But we need to loosen up the whole stock market. We need to get more capital friendly, basically, in this country.
You don't hear 2007, 2008 calling, wanting a repeat of a crisis.
We are miles away from 2007. That's over concern. We've gone so far the other way. At least let's go back to the middle. In terms of
up until now, big index has done relatively well. So let's come back to this valuation argument. Big index has done very well. A lot of people's pension funds, etc., have done, therefore, very well on the back of the argument that the S&P just keeps going higher. How easy is it going to be to get people's pension funds, get the average sort of savings account higher in a world where it becomes more dispersed, that you're looking at things like the FTSE 250? At the moment, all you've got to do is put your money in the S&P. It keeps going higher. Valuations get really high. Mega cap tech continues to do really well. Is it going to be harder to do that in a world where you have a more diversified market?
Well, it shouldn't be harder because there's more stocks to choose from. But
not all of them are going to go up,
well,
whereas the concentration risk has allowed you simply just to go, I'm going to own the Mag 7, it's going to go higher.
Well, this is how markets work, isn't it? It's the emotion. People get crowded and hold on to one idea and they find it very hard to leave it. But the reality is the good guys go first and eventually everyone follows. You look at the Mag 7 already since July. Nasdaq's been stalling out. It's got no momentum. It's a Mag 1 or 2 now. I mean, Microsoft's sort of faffing around its 200-day moving average. And that stock 3 months ago, everyone loved.
Yep.
And they would never dare sell it. And I bet you they're starting to think about it. So it takes time. It takes time. The clever money moves first.
You heard it here first. Chris Watling, CEO and Chief Market Strategist at Longview Economics. Thank you very much indeed. Talking of cores, let's take a look at what happens with the Core 6 this morning here in Europe. This is the picture that we see ourselves with. Certainly some selling going on across Europe. Novo is down by 2.21%. The pharma sector is under significant pressure. Luxury is also soft today. Look at Ferrari. Maybe that's getting caught up in the car story as to what is happening, though Ferrari and electrics is a relatively new phenomenon. ASML is softer. Schneider is down by 0.8%. Even the safety trade, Nestle, you could argue, the staples down by 0.7%. What else are we watching this morning? Joe Easton has all the details.
So we are seeing some weakness, Guy, particularly in these vaccine stocks today. As Chris was explaining just a few moments ago, it's not just about the vaccines, though. It is a broader decline in health, as that Novo move was suggesting as well. But the weakness clearly in the big vaccine stocks. Sanofi in Paris down 4%. Glaxo here in London almost down 4% as well. Alcabello, now this is specifically just vaccines, so there's a good read on what's going on in this sector. And Bavarian Nordic, that is the big Mpox vaccine maker. But bear in mind, they have had their own numbers out this morning as well. But I think part of that 15% drop on that one to do with RFK's appointment to the health department in the US. Then staying in pharma, we have got this deal for Evotec. It's around $1.5 billion market cap in terms of where it closed yesterday, so it is a lot smaller, but it's up 20% as we get a takeover bid from the US. Evotec say that they are looking at the deal. They haven't actually agreed to it yet, but they are keeping an eye on that one at the moment. Then in insurance, Generali extending its gain. It was already up 40% this year. It's up another 5%, almost. Strength in the life business, and the property and casualty losses not as bad as expected. They were quite expected to be quite high given the catastrophes we've seen in the US, also Canada as well. Aegon more in the pension business, that one looking okay over in Amsterdam, gaining around 2% at the moment as well. Then we will flip over and look at Landsec. It is the office owner around the City of London, a lot of city properties. The numbers looking pretty weak, mainly some declines in some of their valuations, but a lot of that, again, it's priced in over the past couple of years, and it is looking to rebound at the moment, up 1.5% for Landsec. Then in rating changes, Burberry, a 20% gain yesterday, the most on record as it rebounded following their numbers, still down sharply, of course, but we have got UBS, a long-term seller, saying that they think the strategy is showing signs of a turnaround. They no longer recommend selling Burberry. They come up to neutral today. Pretty decent move on that one. Then over in renewables, you guys have been discussing, we're seeing renewables higher today. Some traders telling me it's just a bit of an unwind from some of the Trump losses that we've seen, but also Ørsted has a rating change over at DNB. It comes up to hold. So that one is gaining over in Copenhagen, up 1.6% in renewables today.
Joe, thank you. Joe Easton with that rundown, that briefing for you on some of the stocks that are on the move, and a couple of them coming from those really interesting sectors that were on the move over in the United States. We will focus in on the auto sector next. Coming up, EV stocks dropped over in the United States after we saw reports in other media that the Trump administration is considering letting go of some of the subsidies, that boost sales in that space. We'll get to that next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Minutes into the Friday session. Welcome back. You're watching the opening trade. This is what equity markets look like. As you've probably guessed, we're a little lower this morning. As you can see, down by, let's call it 0.6% if we average maybe all of those numbers. That is the picture that we are seeing here in Europe. You're seeing the car sector under less pressure than the pharma sector this morning. Those are the two sector stories that stand out from the US session yesterday. We've got this idea that subsidies are going away in the car sector, in the EV space, and that RFK is going in to run healthcare in the United States. The pharma sector under pressure as a result of that. Tesla and Rivian shares certainly under pressure in the US. This after a Reuters report that suggested that President-elect Donald Trump is considering dropping a consumer electric vehicle tax credit, part of the IRA. Bloomberg's global automotive editor Craig Trudell joins us now to discuss what do we actually know. All of this just what do we know, basically, is the question.
We know that he can't just sort of, do this with the wave of a hand.
This is Trump.
This is Trump.
Mm-hmm.
That these tax credits would need to be taken away, through an act of Congress. And we have seen some indications that there are some members of Congress actually that would be quite concerned about doing away with these tax credits, because there's been a ton of investment in EV and battery manufacturing, and that includes in a lot of red states. And those factories that either are being built or are just spooling up would really be undermined by sort of pulling the rug out from those EVs coming to market. I do think also that the other questions here is also other elements of the IRA that may potentially be vulnerable, including manufacturing tax credits. That those too would be detrimental to those projects.
So this no doubt gets complicated in the minds of many Republicans when they look across their state and the actual facts on the ground as to what's supporting growth. And it gets complicated. Does it get complicated in the mind of Elon Musk as well? Because we saw Tesla hit by this. You assume Elon Musk is in the room when they're talking about these things. He said he doesn't like subsidies, but this one seems to benefit one of his big businesses.
It absolutely does, and I think there has been sort of some lazy analysis that this will somehow be good for Tesla, and I just don't buy it. I mean, They are the biggest EV maker in the U.S. They have the most consumers that have been benefiting from this tax credit, far and away more than any other manufacturer. You can't sort of, on one hand, as Tesla has repeatedly for years now, emphasize affordability and the need to bring their prices down, and then somehow, make this argument that actually, you know what, we don't need this $7,500 to make it easier for consumers to consider our cars. This will hurt them, and I think there is this sort of cold calculation on Musk's part, and you've heard him articulate this on earnings calls, that yes, it'll hurt us somewhat, but maybe it will be even worse for our competitors, and that springs from they are actually making money making and selling EVs. Their competitors aren't, and so he's sort of making this calculation that we won't be hit as hard. That there is some flaws, though, to that.
Or just good for self-driving cars, Chrissy, and good for giving him some leverage to try and push for that. I mean,
Yes, a terrifying prospect as well. I very quickly, Craig, I want to ask a little bit about, does this incentivize then Tesla and Elon Musk to then expose to other parts of the world, ramp up the European consumer base, the Chinese consumer base very quickly?
I mean, I think this is a case of they make their vehicles in the U.S. for the U.S. generally. So I don't think that this necessarily leads to Tesla sort of changing up, how they compete in other parts of the world. This turns the U.S. into a market with less growth potential for them in the next year or two.
Certainly something we're keeping an eye on. Bloomberg's Craig Trudell, we thank you so much. Another sector, of course, in focus is going to be European pharma stocks, also under pressure this morning after President-elect Donald Trump picked RFK Jr. to lead the U.S. Department of Health and Human Services. Joining us is Bloomberg Intelligence senior pharma analyst Sam Fazeli. Sam, what do you make of this drop? Is this actually a valid reaction, or is this simply just trading in sympathy, given so many of these pharma stocks maybe have a limited exposure to the U.S. from a vaccine perspective?
Yeah, so look, I think we've been considering the possibility that RFK Jr. could be in this position. This is not totally news, but the fact that it actually happened is making people worried. If you look at the vaccine, particularly the ones that are purely vaccines, like Moderna, BioNTech, especially Moderna, you would have seen that the stock has been declining for various reasons. One of them has been this. So the discussion here is, of course, now President-elect Trump has said that he's going to be nominating him for HHS, which is the key body in the United States as regards health policy, etc. If, and that's a big if Senate confirms RFK Jr., then of course we're in a world where
where something has changed.
We'll come back to that thought. It's interesting to see just how the share prices are reacting, though. It's not just the vaccine makers that are under pressure here. There seems to be a broader kind of commentary that actually this is going to impact healthcare stocks across the board, and it's going to have multiple impacts. You look at what happens with pricing, you look at what happens with the way that drugs are distributed. There's all kinds of aspects of this story that could change really quite significantly. HHS, this is a huge institution, though.
Yeah, I was really interested in the wording of the announcement from the incoming Trump administration, elected administration. They put pharma products in a list with other things that they think are a threat to the health of Americans. Pharma products as a threat to the health of Americans. So they talk about pollutants, pesticides, food additives, and pharmaceutical products. And I know that that's been, there's been a lot said about medications for depression and the like. And you can see where that thinking comes from. But this is incredible to see those words in the same sentence.
Where does it leave Ozempic? Where does it, like all these other products that potentially are going to have a massive impact into the United States? Does that change going forward? Sam Fazeli is back to answer that where question. Sam, does this go beyond vaccines?
Apologies for my feed being sabotaged by the look of it. Maybe I was saying too many things that people don't like. But the reality is, if you look at this, and I think we talked about this the other day, Guy, there is this sense of anti-science attitude. Because the things that some people are saying, vaccines have been the one thing that have saved humanity, genuinely. Antibiotics, fluoride in water. I mean, I don't know where the science is coming from. There is no science that they're looking at. Therefore, what it tells me is that if this happens, we're going to get somebody in charge who doesn't actually follow true science, but follows what they believe is feeds their views of how health is being impacted by pharmaceuticals, etc. So it's going to be a very difficult period when we are anti-science.
Sam, thank you very much. Sam Fazeli of Bloomberg Intelligence. A lot to watch, and we'll watch those Senate hearings, of course, and confirmation hearings very closely, assuming that they happen. Coming up on the programme, we'll get back to the European growth story. The UK specifically, the economy growing slower than expected in the last quarter. We got those numbers out for the month of September. They looked a little bit sluggish. We'll discuss the outlook for the UK. That conversation coming up next. We had a lot from Mansion House, of course, from Rachel Reeves and from Andrew Bailey at the Bank of England. We'll get to that conversation shortly. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade, 30 minutes into Friday's session. It is a negative session for European stocks. We're down 0.8% on the Stoxx 600. And actually, US stocks, futures worsening just in the last half hour or so. NASDAQ futures now down by over 1%. So a sense of perhaps some of the individual sectors in focus. We've talked a lot about pharma and autos this morning, but also this sense that maybe we are starting to price out, we haven't done yet, but starting to price out a Fed rate cut in December. That's certainly hanging over market thinking this morning as we head into Friday. Now, the UK economy cooled more than expected in the third quarter after a surprise contraction in September as anxiety built over the new government's fiscal plans. It comes as the UK Chancellor Rachel Reeves used her Mansion House speech to suggest it's time to loosen some regulation brought in after the financial crisis.
It was right that successive governments made regulatory changes after the global financial crisis to ensure that regulation kept pace with the global economy of the time. But it is important that we learn the lessons of the past. These changes have resulted in a system which sought to eliminate risk-taking. That has gone too far. And in places, it has had unintended consequences that we must now address.
Let's bring in Anna Andrade from Bloomberg Economics with thoughts on the UK growth story. And so, good morning, Anna. So we hear from the Chancellor. She's sent strongly worded letters of instruction to city regulators, the FCA, PRA, FPC, all of these acronyms have received these letters to say, you know, you've got to put growth front and centre. Is that going to be making the difference, knowing what you know about the growth story up to this point in the UK? What's needed, Anna?
Hi, good morning. So I would definitely say that what Rachel Reeves is trying to do is a step in the right direction, but answering to your question on whether it will make a difference, it's very, very unclear at this point, and I wouldn't say so right now. And I mean, there's two reasons for this. One, what she's trying to do is essentially to consolidate, to do a major consolidation in the pension industry to sort of unlock more investment. But there's a question around whether that investment would flow to the UK in the first place. I mean, investment will flow to sort of places that are attractive, and right now the UK economy, the growth story around the UK economy isn't very attractive. We had GDP data coming out this week, today. It was a little weaker than we had expected, and honestly, the sort of medium-term outlook for the UK economy is also not great. We're expecting modest gains of around 0.3%, and there's not going to be sort of a turnaround in growth anytime soon. So until that happens, businesses might not be sort of convinced that it's in the UK economy that they need to invest.
Anna, of course, it's going to be top of mind for the thinking over at the BOE, but there was kind of a footnote in some of the way that the BOE might be restructuring some of their bond portfolios, one that could free up about £10 billion for the Treasury. Can you walk us through that change, the repercussions for, one, the Treasury, but then also the BOE?
Well, I think now the fiscal space that Rachel Reeves led herself in the last budget was very marginal. I think what we need now is sort of an economy that grows more, that generates more revenue. I think that's sort of, we're talking a lot about how we can get a little bit more money from this change or that change. But in the longer term, the only way that Rachel Reeves is going to get enough money to grow out of its debt problem is by growing the economy faster. And the steps it took in investment will help. The investment that she announced in the past budget will lift output by around 1.4% in the long term, but more is needed. And I think that's also, just going back to the Mansion House speeches that we heard yesterday, I think that's also why Andrew Bailey, the BOE government, opted to talk about Brexit. It's because we're right now in an economy where it's really, really hard to sort of do any single policy that it's a major game changer for growth. And Brexit is actually one of those simple economies that, although it's obviously very politically difficult, it can deliver a big boost to the economy in the long term, and it could help, obviously, Rachel Reeves with her public finances situation.
Anna, great stuff. Thank you very much indeed for the update. Anna Andrade joining us from Bloomberg Economics. Let's talk about another aspect that came out of the Mansion House speech last night, delivered by Rachel Reeves, the Chancellor. The UK is going to introduce legislation next year, legislation to pull 1.3 trillion of local government pension savings into a series of mega funds. Basically, there's a minimum requirement now that is going to be produced in terms of the size of these funds. So you're going to see consolidation and potential efficiencies coming out of this. The new Labour government is trying basically to deliver on a plan to boost private investment and economic growth. Will this achieve this? What impact will this have? Let's get an idea of this. We're joined now by former UK Pensions Minister and current member of the House of Lords, Ros Altman. Good morning. Thank you for your time this morning to discuss this. Let's start off with the idea of consolidation and efficiency. Legislation is going to be coming through. Is this to be welcomed?
Well, in theory, of course it is to be welcomed. We have to see, with pensions, there's always the devil in the detail. And in theory, I think the government's idea is that if you've got bigger pools of money, you get economies of scale in the cost of managing them. But also, more money can be diversified across more different projects and more different investment opportunities, which should give higher returns, but with a broader spread of risk. That's the theory. In practice, it's going to take an awfully long time, I suspect, to merge these funds. And the government really wants to get growth going quickly. It's not clear at the moment what urgency there's going to be in terms of achieving this, and administratively, it's not simple. And just merging funds doesn't guarantee you more investment in the UK or better returns either. So we have to wait and see what is planned.
Better returns and more investment in the UK. Is that the same thing?
Well, it could be, certainly in the shorter term, because one of the reasons the UK has languished and performed so poorly in the last number of years is because pension funds, which are a massive pool of domestic investment that in the past always used to have a significant proportion in UK markets, has been selling down the UK or not flowing into and been diversifying outside the UK, which became a bit of a self-fulfilling prophecy. So if you get more money from our pension schemes returning to the UK, that should help with a re-rating and bring more investment alongside it too.
The UK pension funds, particularly DBS schemes, defined benefit schemes, already invest heavily in the UK. They do so via the gilt market. Now, you do wonder whether or not this is something of a zero-sum game. If the government were to mandate, which some have suggested, that UK funds should invest in the UK, let's call it up to 25%, which is the current tax benefit that they gain, is there a danger that actually they sell out of the gilt market in order to facilitate that, and in the process hit government financing in a fairly significant way? We've already got a big seller in the UK gilt market in the form of the Bank of England. Exactly. If UK pension funds, DBS schemes, start selling, how big a risk would that be to the UK's public finances?
Well, it's a lot more complicated than that, actually. And indeed, the 25% could be of new contributions rather than of existing assets, because I think that would be a more intelligent and manageable way of assuring that money goes into the UK without too much selling. Now, on the defined benefit schemes, I think it has been wrong anyway for them to have so much in the gilt market. Unfortunately, when QE was going on and the Bank of England itself was buying gilts, you had this ludicrous situation of UK pension funds competing with the Bank of England to buy gilts at ever higher prices. That was all somewhat reversed in 2022 with the kind of crash in the gilt market. But as pension schemes head to buyout, they want employers want to get rid of the risk. Those schemes that have already decided they're closed and the employer has no further interest, they are buying gilts because the insurance companies want to take over their assets in much lower risk, supposedly lower volatility investments. Once the insurance companies get hold of the defined benefit assets, the first thing they do is sell the gilts. So you've already got that risk. And I think what's much better is for us to get growth going in the economy, help drive down the fiscal deficit, because you've got private investors and pension funds doing the heavy lifting to try and boost growth in infrastructure and so on. And that itself will relieve some of the pressure on the interest rates in the gilt market. That could be a virtuous circle. And we could use, and I believe we should use, our pension schemes money much more intelligently, and especially with open defined benefit schemes and new money flowing into pensions. We should, I think, mandate at least 25% must go into UK productive assets.
Okay, and Baroness Altman, I know others would argue that that might not be in the best interests of pensioners. I mean, there may be pensioners who do better if their money were all able to go to to the US to invest in AI, or to China, or to India, or to wherever the hot market of the moment is? What answer do you give in that situation to those pensioners?
Number one, I would say if you want the tax relief, you have to, as a quid pro quo, invest 25% of new money into the UK. If you don't want the tax relief and you think other markets around the world will do even better than you would with the help of tax relief, nobody's stopping you. And you would still have 75% of money available to invest wherever you like. And I believe that the arguments which say you shouldn't invest in the UK because it's underperformed in the past miss the point that part of the reason it's underperformed in the past, a large part in my view, is that domestic investment has collapsed from our own pension schemes. And in other countries, Australia, Canada, which the Chancellor has used as an example, a huge proportion of their pension assets are in their own domestic market, unlike ours, where you've got well under 5%. In many other countries, the US, Australia, Canada, Japan, Europe as well, they have 20, 30% or more in their own domestic markets. We have 3 or 4%. So it's clear there's an opportunity here.
I think some may question whether Canada has that significant home bias that you're suggesting, but certainly true that other countries with large pension funds maybe do have that home bias. Former UK Pensions Minister Ros Altman, thank you very much indeed. Don't know I did that. Coming up, the US President-elect Donald Trump selects RFK Jr. to become his health secretary. More on that and Trump's other cabinet picks. We'll talk about that next. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
What we would expect is very clearly that, first of all, the government is back in full force so that they can address the geopolitical, the economic challenges which we are all facing.
We have huge challenges on the labor cost side, on the energy cost side. Bureaucracy costs are too high, and our corporate income taxes are not competitive.
We would like not to exit Germany, but to the contrary, attract capital into Germany. And on that front, I have to agree the 15% cap in the DAX is not very helpful.
Yes, we have to invest, but at the same time, we have to look where you can save money, because that's not for free.
What we need now is, as soon as possible, so the faster, the better, a stable political situation with defining a clear target picture for the economy that is missing.
German business leaders there speaking to Bloomberg over the past month against a backdrop of economic gloom and certainly increasing political turmoil over in Germany. Let's widen the conversation to think about where the EU economy goes. The European Union Commission publishes its autumn economic forecast today, 9:30 a.m. at UK time. So in around 45 minutes time, we'll get the details of where they see things going. Bloomberg's Oliver Crook will be looking for the details there, and he joins us now from Brussels. Ollie, you are what, forecasting a forecast here? Is that what we're doing? What are you looking for in these projections?
Yeah, exactly right, Anna. So listen, these are going to be the sort of the forecast for GDP and CPI, the sort of things that will be watched very closely here among everybody in Europe for next year, but also the first forecast into 2026. And we don't have the numbers yet. We're going to get them very shortly. But if you look at the sort of Bloomberg aggregate for what to expect for GDP and CPI, for this year, we expect growth at 0.7%, less than a percentage point of growth across the Eurozone. Next year, that ticks up to 1.2%, and then into 26, coming up to 1.4%. A couple of points to make about that sort of these sorts of growth figures. These are very, very muted figures of growth for you, even for Europe, right? There were some very good years after the pandemic that were sort of brought back by a lot of the stimulus, but these are even below trend what we got going into the pandemic. So this is much lower, and this is really coming into relief because the Europeans now are realizing that they're going to be competing intensively against China, against the United States, and really need to find ways to boost growth. There is a silver lining, however. It is not, unfortunately, on the growth front. It is on the inflation side, where you see that we still have inflation in Europe of about 2.4% this year. They're expecting it to drop down to 2% next year and into 2026. But of course, there are a ton of risks on the horizon. We'll be looking through these sort of forecasts to also see kind of where the growth is concentrated in terms of sectors, but also geographically across Europe.
Ollie, I'll give you two quotes. Everybody has a plan until they get punched in the mouth. That's relevant for this weekend coming up. And it's difficult to make predictions, especially about the future. Talk about these predictions going forward, these estimates as to what Europe is going to be looking like going forward. Could it be about to be punched in the mouth by the Donald Trump presidency? Therefore, does everything fall apart in terms of what happens next and the response that comes through? How difficult is it to make predictions in a world where we don't know what impact this Trump presidency is going to have? We're putting together a cabinet that could produce some quite out there outcomes.
Absolutely, Guy. And I mean, I think the differences between Europe and Mike Tyson is perhaps a little bit less prepared to be punched in the face. And that's kind of the issue before the European Commission. And the issue that you're talking about, Guy, is there's a huge shadow that looms over these numbers and over the European continent. And it's in the shape of Donald Trump. We do not know what we're going to get from the Trump presidency yet. We do not know what we're going to get in terms of tariffs. If we get 10% tariffs, as he has talked about on the campaign trail, that costs the European economy, according to Goldman Sachs, 150 billion euros every single year. That is the difference when you look at the sort of forecast that we were just talking about between some growth in Europe and zero growth in Europe, right? There's also the question of China. How does China play into this? Is there going to be growth in China? Could that help the Europeans? But also, if Donald Trump slaps 60% tariffs onto the Chinese economy, all of that overcapacity then flows into Europe. That might help on inflation, but that is flying directly in the face of what the European Commission wants to do with this new sort of commission and its sort of Draghi report, which is to become more competitive and to be more sort of self-reliant. These are all the issues that they're tackling. And then, of course, now European leaders are beginning. I'm saying beginning because over the last week, everybody has been very reticent to say anything negative about Trump or to even consider that he may be sort of slapping tariffs on. We had Emmanuel Macron speaking earlier this week saying that we are very clearly entering a world of tariff wars. So the question now for the Europeans is they need to start to get out of reaction mode into proactive mode and to start to discuss what these sort of Europe first policies might be able to look like. And that is going to be sort of what is going to be in focus going into this new commission, which will start in December. The issue you guys have is, of course, the question of fiscal. There's a huge amount of debt in Europe, so really not in a strong position to get punched in the face.
Bloomberg's Oliver Crook there walking us through some of the economic forecasts and sentiments over in Brussels. We thank you so much. You don't want to miss Oliver's interview with Paolo Gentiloni, the EU Economy Commissioner, excuse me, I can't speak today, at 10:45 a.m. UK time. A fascinating conversation, of course, is some of those budgets are still yet to be submitted to the EU. That conversation, 10:45 a.m. UK. But let's kind of zero in on what Ollie was talking about, is what's happening over in the States, especially with Donald Trump and some of his cabinet. They are taking shape as the president-elect selects vaccine skeptic RFK Jr. to become his Health and Human Services Secretary. For more on those cabinet picks and the week we've had, Bloomberg's senior writer, Stephanie Baker, joins us around this table. All right, so for our international audience, I think we should preface the RFK conversation by saying he comes from a massive American political dynasty, one that has kind of shunned him from their own politics. They had endorsed Biden and then Harris, and of course, RFK Jr. has taken a very different approach after having run for president himself. What policy changes could come with him in this role?
Right. I mean, the reason why this is so surprising is he wasn't asking for it. The expectation is that he would have take a health czar role in the White House that wouldn't require confirmation. So this did come as a surprise. Obviously, he's a noted vaccine skeptic. He's come out against fluoride in water, traditionally a local issue in the United States. But he's also talked about food policy, and I think that's an area where he could get more consensus and support. He famously attacked Fruit Loops in the United States for having too many additives, but he got his facts wrong, saying that other countries didn't have that. But he's right on a lot of those issues, so that's a place where he could get more support. That's notable that to be confirmed, he needs to go through 2 Senate committees. Not only the Senate Health Committee, but the Senate Finance Committee, because Health and Human Services oversees Medicare and Medicaid.
Yeah, and tell us a bit about how that process works, because you expect a Senate hearing, and yes, the GOP controls the Senate, but it doesn't take that many senators to rebel for you to get some of these appointments denied, but that assumes you get a hearing. So tell us about the process.
Right, so Republicans still have a relatively slim majority in the Senate, so all it takes is a handful of Republicans to break ranks and dissent on any of these nominations. So, whether or not they will have the courage to come out and defy Trump after he led them to this sweeping victory remains to be seen. Trump has obviously talked about wanting to do a lot of these appointments under recess appointments that would require the Senate and the House to vote by a majority to adjourn the Senate to allow him to appoint these figures for as long as 18 months. And, I think there'll still be opposition. It's not going to be so easy to do recess appointments.
So there's a lot of questions here in Europe about what all these policy changes, given so much of this is inward looking. There were plenty of very controversial picks this week. Tulsi Gabbard, of course, being one of them as Director of National Intelligence. Plenty Russia-Ukraine conflict talks when it comes to the Defense Secretary, the CIA Director, among many, many other positions. What stands out to you in terms of the most game-changing for European policy?
Well, obviously, Tulsi Gabbard is a shock pick for leading all the U.S. intelligence agencies. She has met with Syrian leader Assad. She has, parroted various Russian talking points, and the idea that she'd be overseeing U.S. intelligence is a shocker, and I think she will face opposition if she comes up for confirmation hearings. Pete Hegseth as Defense Secretary is another shock pick. He served in a relatively junior position in the military. It was a Fox News anchor. Yeah. He's notable for his tattoos. He has the Jerusalem cross, which is a symbol of white nationalism. Now, he said that these are just Christian symbols, but that is a very controversial appointment beyond the fact that he just has no management experience and is sort of patently unqualified to lead one of the largest armies in the world.
Stephanie, great stuff. Thank you very much indeed, Stephanie Baker, on what is happening in the formation of the Trump cabinet. Let's talk about what is coming up next. What is coming up next? We've got Friday to get through, but the weekend is almost upon us. Christmas markets are going to be kicking off this weekend. I think up in Warwickshire. The German ones kick off next weekend. The ski season, I think, starts next weekend.
It's too early for Christmas markets. Can I just make that really boring point?
In the car on the way in the morning, the music has definitely started on the radio stations.
Yes, and
Christmas
they sell
music.
Christmas food from August. It doesn't mean you have to buy it.
The lights are everywhere. I'm eating it up. In the States, we still be in Thanksgiving mode right now, so I've
got to get through that, don't you?
I know.
Yeah. Sport, big weekend of sport.
Yeah.
So England's going to go aerial at Twickenham this weekend, I think, to try and beat the box. I think that's going to be pretty hard. They're looking quite good at the moment. I have to say, my kids are quite excited about Jake Paul versus Mike Tyson. Everybody has a plan until they get punched in the mouth. Jake Paul.
And you took this to the world of tariffs earlier, which was exceptional, I thought. Very nice little metaphor going on there. But yeah, we'll focus on the boxing perhaps. Because of the boxing, but maybe because of it being all live on Netflix, which is something of a it's not a first, is it? But it's a big deal when they're
getting into
live
more
events.
live things.
Absolutely.
And streaming apparently makes money, according to Disney.
Going onto the streamers. Right, speaking of the weekend, be sure to catch up with Bloomberg's new weekend edition. Plenty of essays, reviews, interviews and stories for you. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
European stocks and US futures fall after Jay Powell says there is no hurry to cut rates. Pharma stocks slip after Donald Trump selects vaccine skeptic Robert F. Kennedy Jr. for health secretary. There's no room, though, for JP Morgan CEO Jamie Dimon. Plus, Chinese retail sales grow at the strongest pace in 8 months as signs emerge that Beijing stimulus efforts are paying off. Let's check in on markets then. European markets under pressure once again. You are set, at least at this stage, for 3 straight weeks of losses across the European equity space. The FTSE 100 is flat. On the downside, when it comes to your sectors, the biggest losses coming through from, yes, healthcare as a result of that appointment, or at least tapping up of JFK Jr. for that key role of Secretary of State for Health. Over in France, the CAC 40 is off by 0.2%. You're seeing similar losses over in Germany. The IBEX, though, in Spain is just holding on to gains of 0.5%, and you're modestly higher on the FTSE MIB as well. But again, broadly, across the European benchmark, you are seeing losses once again risk off. And part of that is down to what we've been hearing from Jay Powell. 50-50 now, it seems, in terms of whether or not they go again in December. That's the market expectation. Powell sounded, to some at least, a little bit more hawkish yesterday, talking about the strength of that US economy. S&P futures then, after losses of about 0.6 yesterday, looking at a similar picture again today. Looking for the next catalyst, it seems, for US equities. You saw yields up on the back of that speech from Powell today. There's a little bit of a bid at the front end, at least. 4.32 on the 2-year. Yields just down 2 basis points. Euro dollar at 1.05. The pound as well in focus on the back of softer economic growth than had been expected in the third quarter here in the UK. Brent 71.68, down 1.2% on concerns about a glut in that oil market. The show starting right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. European stocks and US futures, as we mentioned, falling following those comments from Jay Powell. The Fed chair says the recent performance of the US economy has been good, indicating there is no rush to cut interest rates.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Okay, Jay Powell speaking yesterday, of course, sounding at least to some a little more hawkish. Very pleased to say I'm joined now by Melanie Baker, senior economist at Royal London Asset Management and Bloomberg's managing editor for FX Rates, EMEA and US, Rachel Evans. Melanie, let's start with you. Good morning. How has the voicing of some of these Fed officials, the sounding coming through from Jay Powell and others, adjusted your views on where the Fed goes next? Do they cut again in December, or is that now off the cards?
I think it's neither. I think it's sort of a little bit on the fence on this one. So I think after the press conference last week, it already felt to me as if they were kind of trying to prepare the market a little bit for a potential pause. And I think we've had that again and enhanced in a way from Powell last night. I wouldn't see this as anything more than a potential skip, or just allowing them, if they feel it's necessary, to sort of slow the pace at this point. But yeah, definite kind of change in tone, I think.
A changing tone. As you project into 2025 then, Melanie, markets now expecting fewer than 2 rate cuts, fewer than 50 basis points between now and June of next year. Does that align with your view in terms of what to expect as we look into 2025 for the Federal Reserve?
It's not far off. It's probably a little bit less in terms of rate cuts than I'd have. I'm still inclined to think that maybe next year we get 3 to 4 rate cuts, but there's a lot in the balance right now. I mean, the economy is performing really quite well. You know, the labour market is relatively solid if you can look through that October number, of course. And on the inflation front, just things a bit less reassuring than they were. And on top of that, of course, we now have a Trump presidency, and the combination of his policy proposals at least looks likely to be inflationary to me.
Okay, let's bring in Rachel at this point then for the markets view and how markets have adjusted. It's been a choppy week again in terms of how markets are priced around the December meeting for the Federal Reserve. How much of that is priced in right now across the Treasury curve, and how much more work is to be done?
Yeah, I think it's a good question because we've been having these kind of different buffeting factors for the bond market in recent weeks. We obviously had the Trump trade, which has been pushing up yields. That seems to have eased a little bit, and people have been focusing more now again on monetary policy in the wake of those Powell comments. We've really seen yields backing up quite a long way, though, as a result of kind of those two different impulses. We're around 4.45% on the 10-year at the moment. That's still up 14 basis points from a week ago. So we've really kind of been continually sort of adding basis points to yields. Yields have been continually rising. So I think there's a question mark about how much further that can go off this idea of a Fed pause or a Fed skip. I mean, we've got to remember that, kind of in September, we saw the dot plot suggesting that the Fed would cut 3 times this year. They obviously went big in September, and then again in November. So maybe they can hold off on December and push that to January. But there is some expectation that we might see, a cut still coming in December. It's about 60% priced at the moment.
Okay, so if they do hold in December, then Rachel, does that push yields up to are we getting close to that 5% level? Because then, of course, we have to think about the interlinkages between yields and an equity market that is still in bull market territory, even if there's been a bit of a pause in the last 48 hours.
Yeah, and the Fed doesn't have a mandate, of course, to worry about the stock market and stock market performance, but they don't like to see too much volatility or instability coming through to markets. So the impact of higher yields kind of spreading through to equities is going to be something that's on their radar, even if it's not necessarily motivating their decisions. And I think to your point about kind of, where do we see yields sort of heading back to, 5% is very much now within, people's bingo card about what could be next on the agenda. Whether we get that this year, I think maybe that would be a little premature. We need to see kind of, whether we do get that pause. And also, I think a lot of the move up in yields has been predicated on this idea that Trump will be inflationary in his fiscal policy. We obviously know now that he has Congress as well. That's something that, again, favors higher yields. We don't yet know the detail of the policy, so we may need to wait till we get the inauguration and we get some of those policies laid out for that kind of leg higher up towards 5% to really play out.
Yeah, and you speak to that uncertainty in terms of what policy is prioritised and in what time frame it's enacted as well, and how the markets have to think about that. With the 10-year right now stateside at 4.45, yields essentially flat on the session today when it comes to that main benchmark. Melanie, let's bring you back in, but switch focus to what's happening here in the UK, because of course we had a weaker GDP print for the quarter, the most recent quarter, the third quarter, and again, a reminder of just the challenges for this UK economy. Does it change? Does it move the dial again for particularly when it comes to hawks at the MPC, who have kind of been pushing this line that they need to be still pretty restrictive when it comes to rates because of those inflationary risks?
Yeah, I don't think it does. I think the inflation data next week is going to be much more important for those hawks. What they want to do, to be able to do, is worry less about inflation persistence. So I think it's going to be more from that perspective, watching the inflation data and watching the wage data. I think if you look under the surface of today's GDP figures, they weren't actually quite as weak as they look on the surface either. So again, I don't think today's data is a game changer.
Okay, not a game changer yet for the BOE. Markets pricing in, I think, 2 cuts between now and August for the Central Bank of the UK. Let's get back to the US politics then, because, of course, as Rachel and you both are kind of been pointing to, it's the uncertainty there, and at least the details coming through, that is having to be factored in by markets as well, particularly on the kind of inflationary impulse. But stock-specific, sector-specific, certainly today, with another controversial nomination by the US President-elect Donald Trump, who has tapped Robert F. Kennedy Jr., a prominent vaccine skeptic and critic of Big Pharma, to run the Department of Health and Human Services. Let's bring in Bloomberg's senior writer, Stephanie Baker, who's been looking at some of these new appointments. Stephanie, are we getting kind of voodoo medicine, voodoo health coming through for, a voodoo doctor, essentially? Is that the critique that's been labelled at this appointment, what it means for the health of US citizens?
Well, he's famous for being a vaccine skeptic. He's talked about removing fluoride from the water, traditionally a local issue in the United States. But his pick will be very controversial. It's unclear whether he'll get through Senate confirmation. He has to go through 2 committees, Senate Finance as well as Senate Health, because the department he's picked to oversee runs Medicare and Medicaid, these huge budgets. I think that these appointments signal this is not just about loyalty, it's not just about disruption, it's not just about daring the Senate to defy Trump after he swept them to a victory, but he's embarking on a revolution in the United States. He's choosing people that have vowed to blow up the very departments and agencies they are chosen to run. So I think it remains to be seen whether or not these picks can get through, whether or not the Senate actually does its job and demands a full hearing and enough senators, Republican senators, vote to oppose some of his more controversial picks.
Okay, so that's still a question mark, clearly, in terms of whether or not he gets that final sign-off. But again, as you say, it could be revolutionary in terms of how these government departments are treated under some of these names, if indeed they get confirmed. When it comes to the Treasury Secretary, we're still waiting for that announcement. Someone who we can rule out is Jamie Dimon, the CEO of JP Morgan. Let's take a listen to what Jamie Dimon had to say when he found out and was asked about the fact that he was now not going to be part of this Trump administration.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
Okay, Jamie Dimon speaking at the APEC CEO Summit in Peru. For context, of course, Jamie Dimon had not been asking for a role in the Trump administration, but of course he is a name that many people have pointed to over the years as someone who could potentially have political aspirations. What do you make of what we've heard from Jamie Dimon, what we've heard from Trump in terms of the message he put out around the CEO of JP Morgan, and what it tells us about who is likely to be the Treasury Secretary?
Well, the leading candidate that most people think is going to be picked is Scott Bessent, a hedge fund manager from Florida, but I've heard some of the speculation that maybe his support is being undermined from people talking about his past work for Soros Fund Management. As we know, there's no love lost between Trump and George Soros. So whether or not that will he will actually be the pick that gets through. I've heard Howard Lutnick is another one that was potentially in the running. So it remains to be seen. That's the last big one, I think, for him to name.
Okay, that's what we're waiting for. The Treasury Secretary, at least the nominee, who's going to be tapped for that role. Stephanie Baker, thank you very much indeed for the latest names that have come through in terms of some of these potential nominees to the incoming Trump administration. Talking of which, let's get back to what's happening in terms of European pharma, because that sector has been the worst hit on the back of this news that Donald Trump's choice to run the health department in the US is going to be Robert Kennedy Jr. Again, he has to get through that confirmation process to run Health and Human Services Department stateside. Let's bring in Joe Easton then for a check on the equity market moves around the tapping up of JFK Jr. What are we seeing, Joe?
So we're seeing some significant declines in these vaccine stocks today, Tom. Take a look at Sanofi, known for its respiratory vaccines, and also Glaxine, which does a big business in vaccines for shingles. Both of those seeing significant declines. Down 3% almost for Sanofi. Glaxo coming up a little bit, was down around 4%. And the other vaccine makers, Alka, Bello and Bavarian Nordic, which coincidentally had its earnings out today, hit by this news. But this isn't just about vaccines. It's broader healthcare as well, because Trump wrote on a post on X that the industry has been subject to misinformation, slamming the American consumer of pharmaceuticals, according to his post on Twitter or X, and therefore we're seeing losses in any company really that's exposed to the US healthcare sector, including over in Switzerland. Take a look at Roche on the screen here, down 2.4%. Novartis, the rival there, Novo Nordisk, Europe's biggest pharmaceutical company, and AstraZeneca here in London as well, down almost 3%. And as such, healthcare by far the worst performing sector in Europe today. In terms of the sector breakdown, we can see it right down the bottom there, down 2%, underperforming the main market, which is down just 0.4%. Clearly, RFK's appointment spurring fear in the market for healthcare stocks today, Tom.
Joe Easton, excellent wrap of the equity market moves with that focus on healthcare. Thank you very much indeed from our equities team, of course. Coming up, China reporting better than expected retail sales. We're going to take a look at what that means for signs of potentially an economic turnaround. Is the consumer of China feeling a little bit more optimistic? That is next. This is Bloomberg.
everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome back. Happy Friday. Now, China's economy showed signs of stabilization in October, buoyed by better than expected retail sales. Let's get more then from our senior Chinese economy and government reporter, James Mager, staying late for us in Beijing. James, how strong is this data? Will it be sustained? Is this the turnaround we've been looking for?
It's too early to say whether this is the real turnaround. I mean, obviously, retail sales was a lot stronger than expected. And part of that is because in October, you had a long holiday, so a lot of people went away, went traveling, and spent a lot more. You also had the Singles Day promotion started early this year, which is actually a online shopping festival in November, but there was a lot of discounts online available in October as well. And then the government has also been handing out, local governments have been handing out consumption vouchers, so you can buy new toasters and fridges and that kind of thing. So those things all boosted retail sales to a record 4.5 trillion yuan in October. But, we're going to have to see whether that continues into November and December, or whether this is a one-off boosted by those factors. And I think if you look at the industrial side of the economy, there was a slowdown there, but actually it wasn't slow enough to sort of really solve some of the problems of overcapacity that Chinese industry is facing. Steel rebounded, copper rebounded, cement and glass fell, but not as much as you probably would expect, considering the housing market is still in the doldrums. So, this is a better month than we've seen for quite a while, and obviously some of the stimulus and some of the, the things that the PBSC and other government departments have done has helped the housing market a little bit, but we'll have to see whether this extends beyond this October through the end of the year and into next year.
Well, James, on that question then, what is the assessment of you and the team sitting there, pouring through the data with a finger on the pulse of this economy, in terms of what it does, in terms of moving the dial around some of those key challenges and problems that are facing that Chinese economy? Are we starting to make some headway?
You're starting to see some signs of life in the housing sector. There was a pickup of sales in October, but so the real problems of overcapacity that were caused by the collapse of the housing sector, those are still to be dealt with. So you still have massive overproduction of steel, and that is flooding out into the global market. You're seeing record or almost record steel exports again, to the biggest since 2016, and that's really not being dealt with fast enough to stop that that flooding out overseas. There's still a lot of weakness in the retail economy. Growth rates are much lower than they were before the pandemic. You wander around Beijing, and there's lots of shops and restaurants that are shutting down or that have closed. You go to department stores, shopping centers, and there's lots of empty stores. So, the sign now is of possible start of a recovery, but even the things that the government has announced so far are much more long-term and mid-term plans to fix things like government finances, to fix things like over-indebtedness in the government sector, but that's not going to provide a boost to consumption right now. And so, unless the things we saw in the October data today continue, it's still going to be quite a long haul, I think, for the broader economy.
Okay, so still some question marks as to whether or not this is a sustained turnaround that we're starting to see. Some mixed data then coming through out of China, with a breakdown there and the context coming through from James Mager, joining us live from Beijing. Let's get back to Melanie Baker from Royal London Asset Management right now. Melanie, I want to question to you then on China. Is 2025 the year, do you think, when China can engineer a turnaround?
Oh, that's a big question, isn't it? I mean, I'm definitely more optimistic than I was, right? We have seen a change from policymakers, a big step up in stimulus. But I mean, what you're not seeing, as has just been talked about, are measures that are really going to boost consumer spending directly over the next 12 months as of yet. And then you've still got sort of significant longer term problems in China, particularly around population growth, that really constrain, I think, China's longer term growth rate.
Okay, Melanie Baker from Royal London Asset Management. Still not convinced that China can turn things around. Still a lot to watch there. Uncertainty. Thank you very much indeed, again, for giving that economic lens to what we're seeing in terms of adjustments around expectations for the Fed, the BOE, and China, and the support that's coming through on the back of that data. Melanie Baker, Senior Economist at Royal London Asset Management. There's plenty more coming up. Stay with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back. Happy Friday. We're going to check pre-market on Domino's Pizza because Berkshire Hathaway has bought stock in the company. Buffett's Buffet taking a slice of this company. 3.6% slice of Domino's Pizza, valued at about $550 million. The stock, as you can see, is up 8% on the back of that, and I will not apologise for the cheesy puns. Right, here's what else you need to know this morning. The US Federal Trade Commission is reportedly set to investigate anti-competitive practices at Microsoft's cloud computing business. The FT says the regulator is looking into allegations that Microsoft is blocking customers from moving data from its Azure cloud service to rival platforms. The report says tactics include exit fees and punitive licensing terms. EU regulators have fined Meta nearly 800 million euros for tying its Facebook Marketplace classifieds service to the social network. The European Commission also ordered Meta to refrain from imposing unfair trading conditions on rival platforms for second-hand goods. It's one of the final acts for EU antitrust chief Marguerite Vestager, who is set to leave her post before the end of this year. Coming up, after the UK Chancellor said the crackdown on banks in the wake of the global financial crisis went too far, we're going to speak to Nigel Wilson, former Chief Executive and Legal and General Chairman of Canary Wharf Group, for his views on what we've been hearing from the UK Chancellor and some of those pension sector changes that are now in the pipeline. That conversation's coming up next. This is Bloomberg.
You missed it on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, welcome to the Pulse. I'm Tom McKenzie in London. Happy Friday. These are your top stories. European stocks and US futures fall after Jay Powell says there is no hurry to cut rates. Pharma stocks slip after Donald Trump selects vaccine skeptic Robert F. Kennedy Jr. for health secretary. But there's no room for JP Morgan CEO Jamie Dimon. Plus, Chinese retail sales grow at the strongest pace in 8 months as signs emerge that Beijing's stimulus efforts are possibly paying off. To the UK now. The UK Chancellor says the crackdown on banks in the wake of the global financial crisis has gone too far, vowing to ensure regulations focus on growing the economy. This comes as the government attempts to win back the business community following criticism, of course, of last month's budget.
It was right that successive governments made regulatory changes after the global financial crisis to ensure that regulation kept pace with the global economy of the time. But it is important that we learn the lessons of the past. These changes have resulted in a system which sought to eliminate risk-taking. That has gone too far. And in places, it has had unintended consequences that we must now address.
OK, joining us now is Nigel Wilson, chairman of Canary Wharf Group and former chief executive of Legal and General. Nigel, do you welcome the comments from the Chancellor around regulators maybe going a little too far in trying to contain risk?
I absolutely agree with what you said, because it's the truth. We've been over-regulated with excessively risk-averse regulators, not just in financial services, but I would say in every industry in the UK.
How far, I guess the question is then, how far should this government go in re-injecting risk? And are we ready, the body politic of the UK, the people, the consumers of the UK, ready for that additional risk?
But if you're at negative risk, in a sense, what you've been doing has resulted in very poor outcomes, and you want to do something that's going to deliver much better outcomes. And I'll take example, various asset classes are often very difficult to get approved by the regulators for getting appropriate capital treatment under a reasonable time frame. So you end up investing in the US equivalent of them instead of investing in the UK. And that's not a good outcome. We just don't invest in the asset class because the regulator hasn't approved it in the UK. That's just total risk aversion, and it results in terrible outcomes and no UK growth. If we're now going to speed up the method by which the regulator approves new asset classes and the capital required underlying those assets, that will make us much more competitive as a country.
Are there specific measures you would like to see this government put in place to constrain regulators and to inject a little bit more risk then? How far specifically, what do you think the policy prescription should be at this point?
I think the regulators realise that they've made errors themselves, whether that's the water industry, the telecom industry, the food and drink industry.
Motor financing right now is a potential issue brewing for UK banks.
Well, and it is an issue, and it's got to be resolved. And it's an old issue that's going to cause further problems. But as a country, we're bottom of the G7 every year in terms of investment. And a lot of that to do is with excessive risk aversion within the regulators. This has to change, because we've got all the capital. We've got $6 trillion of long-term capital. It's hopelessly misallocated and there's very little risk in it compared to the US equivalent. And if the US have got it right and we've got it wrong, and they're going to grow faster and they're delivering much higher returns in the US than the UK, we've got to learn from the lessons of the US and try and transfer them over here, take the best of the US, transfer them, and actually start competing on at least an even keel from a regulatory point of view.
When it comes to the pension changes, the other significant announcement that came through from this Mansion House speech from the UK Chancellor, it seems they are drawing lessons from the US, from Australia, from Canada, with the push for mega funds that will be legislated. Is this just the opening gambit? How far do you think this should go? How consequential do you think it will be, essentially?
It's just the opening gambit. I think because we've been, again, excessively risk-averse in what pensions have invested in. Essentially DB schemes are in cash and gilts, and even DC schemes. We've got to get them somehow to allocate some of their capital to UK infrastructure investment and UK growth companies. And personally, I would use soft compulsion, say actually the target amount for that is 5%, and the target for infrastructure and the target amount is 2%. Those are not wildly radical numbers, but if you're talking about a fund which is going to be 800 billion or a trillion in terms of DC, those are large amount of numbers that would make a difference here in the UK. We have 300 billion in cash ISAs in the UK. We're the only country in the world that gives a tax benefit for investing in cash. Imagine if that 300 billion was invested in higher earning, higher performing, brackets, more risky assets over a 1-year VAR period, but over a 10 or 20-year period, absolutely lower risk than actually investing in cash over that period.
Yeah, and to be clear, DC, defined contribution and defined benefit pensions. How far do you, at this point, we're just looking at local governments being pulled in terms of their pension funds. When does it expand? What is the time frame that you're hearing about when that expands?
They want to get on with it. You know, the first thing is that unlike the budget, which was an ideological budget, this is actually a discussion about growth and a growth agenda, which is great to hear. So the direction of travel is actually right. I talked to the Treasury afterwards, and they tell me, yes, we're really going to crack on with this, and we're going to get legislation approved early next year and really begin to make a difference. But it's a necessary condition, not a sufficient condition through growth. This in its own right will, as we talked earlier, LGPS used to own, which is the local government pension scheme, almost 40% of their assets were in UK equities. Now it's less than 10%. And we've had a lot of consolidation already, and consolidation resulted in less investment in UK equities rather than more.
Okay, so do you think the legislation gets through, or
yes,
they start to draft it and push it through next year?
March or April next year.
March or April next year, but when do they move on and expand this? Are they accelerating on expanding this to the private sector?
They will accelerate this. I'm absolutely, because they have to. If they want a growth agenda, they've got to have growth capital in the UK. And at the moment, everybody in a business point of view is on the back foot as a consequence of the budget, and that's not a good first step for the government.
You described that just now as an ideological budget.
Yes.
What do you mean? Was that an anti-growth budget?
That was an anti-growth budget, but it was actually, I would say, traditional Labour. Let's sort out the health system. It's very much what they did in 2020, but the situation with 2020 was very different, where Gordon Brown and Tony Blair inherited, in 1997, inherited from the Tory government an economy that was growing at 4%, and they had a budget surplus for the next 2 or 3 years. So you could massively increase spend in health. This time, you had to look for the offsetting tax to pay for that, and that was very painful. And that was very painful.
Did they lose some of the business community on the back of that budget?
I think they lost some of the business community on the back of that, because it would have been better if Rachel had done them the other way around. Actually, had the pro-growth, reducing regulation, consolidation. We're going to make pensions a source of capital for growth in the UK, and then done the budget.
So you talked about some caps that you would want to introduce.
Some guidelines.
Guidelines, okay.
Guidelines on soft compulsion. These are the targets that you should be aiming for.
But you've made it pretty, it's pretty stark, the numbers, the stats, in terms of the lack of investment in UK assets historically, or at least where we've come from since the 1990s, early 2000s.
Yes.
You called it shocking. Do you think at some point there's going to have to be a mandate to invest in UK assets?
Yes, I've been in favour of mandation for about 15 years.
Because there's a lot of pushback to that.
There's a lot of pushback to that, but there was a lot of pushback to auto-enrolled DC pensions when they first came in, and they were soft compulsion. You had to opt out of the pension scheme, not opt into it, and that was a good thing to do. And we again were at the centre of that, and there was a price cap introduced for that to actually drive growth in those sectors. And Steve Webb was a very radical pensions minister, and he really made a difference. And the reason we're heading towards £1 trillion in DC pensions is because we were bold.
How vulnerable, before we let you go, Nigel, because of your deep experience in the UK business environment, how vulnerable do you think UK PLC is to an incoming Trump administration?
No, I think one of the things that's going to happen is Trump's going to cause a catalyst across Europe for Europe to start working together. And actually, one of the offsets is going to be actually Europe, which is in a mess. I mean, you were talking earlier about no growth in Germany, no growth in France, no growth in Italy, Spain, minor amount of growth, a few of the smaller countries doing okay. And actually, we need a growth agenda for the whole of Europe. Trump's going to make that more difficult, and therefore, hopefully, we'll get to cooperate more. Keir Starmer said that, the Governor of the Bank of England said that, Rachel Reeves has said that. Brexit was a huge mistake. A big mistake. We could rectify it a little bit by getting closer to Europe, and Europe may welcome us much more now, because we're all going to be suffering the pain from Trump.
Okay, Nigel Wilson, always appreciate your time. Finger on the pulse, of course, of the UK business.
Thank you.
Environment and sector, of course. Nigel Wilson, chairman of the Canary Wharf Group and former chief executive of Legal and General, on the pension changes and the need for more risk-taking when it comes to the focus on the regulators and how they can change to ensure that there is greater growth in this UK economy. We're going to bring you live pictures right now. Nigel was just talking about the lacklustre growth, if there is any, across Europe. Well, we're going to get some forecasts right now. These are live pictures of the European Commission's autumn forecast press conference in Brussels. You're seeing the European Economy Commissioner Paolo Gentiloni saying the euro area is set for a consumer rebound, but risks are high. We're going to have more with Bloomberg's Oliver Crook, who's listening in with the details, with the context, what we're hearing in terms of some of these renewed forecasts from the European Commission. That's coming up. This is Bloomberg.
Productivity is set to stagnate this year, and it is then expected.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back. The European Commission says euro area economic growth will pick up next year as obstacles to consumption and investment fade, though geopolitics poses an increasing threat. For more on the numbers out in the last few minutes, Bloomberg's Oliver Crook joins us with quick-fire reaction from Brussels. Talk us through the Commission's report then, Ollie. What have they been saying about the prospects for the Eurozone?
Yeah, so listen, Tom, we should look at kind of the figures that we got, namely out of the GDP and CPI. These are the two figures that people are going to be most sort of concerned with. We can start with growth in terms of what the EU Commission is expecting. What they are expecting in terms of growth for this year is 0.8% growth in the Eurozone. They're expecting that to come up to 1.3% next year, and then into 2026, 1.6%. These are obviously increasing trends. This means that growth is going to rise, though very, very gradually in the Eurozone. These are not particularly encouraging figures, Tom. What we have seen after the pandemic, there was a big boost due in large part to a lot of stimulus that took place. But these numbers that we're getting now out of the sort of Europe in terms of forecast for growth are lower than the trend that we had before the pandemic. So this is hardly sort of hugely reassuring information. They're also saying that basically consumers are going to come back. There's going to be some more spending. They've seen that happening this year. But one one thing that they highlight is also going to be less investment. There's going to be a contraction of investment going into the end of this year. This is not an encouraging sign on a number of fronts. On the question of inflation, they expect that inflation across Europe will reach 2% by the fourth quarter of next year, finally hitting that ECB target after that huge sort of inflationary spike that we've been dealing with over the last few years. We should say that that is a bit of a discrepancy from what we've heard from a number of ECB speakers who expect that to hit 2% in the first or second quarter of next year. So we'll ask Paolo Gentiloni about that when he comes on set to talk a little bit about it. But we should also say, Tom, these numbers you've got to take with a huge grain of salt. You have to ask yourself, are these numbers really valuable at all? Because there's so many risks on the horizon that could really impact this.
Yeah, well, there's an elephant in the room, isn't there, when you're talking about some of these numbers and some of these projections, and that elephant is, not to be unkind, but, you know, in terms of policy at least, is Donald Trump and the incoming Trump administration. How vulnerable, then, are these projections to the whims of the incoming US president?
I think they are supremely vulnerable, Tom. I mean, I think that these are probably some of the most vulnerable economic figures we've ever gotten out of this sort of Eurozone in sort of recent times, because we don't know exactly what we're going to get from the Trump administration, but we know we're going to get something. And if it's 10% tariffs, as he's talked about on the campaign trail, or 20% tariffs, I mean, we know what 10% means according to Goldman Sachs. That could hit European growth to the tune of 150 billion euros a year, right? That is the difference between, from the numbers we're getting out of the Eurozone, some growth in Europe and zero growth in Europe, right? There's also the question of how it could bear on inflation. This could be a big driver up in terms of inflation. This is not even to talk about the complexity of the EV tariffs and the own tariffs, the trade war and disputes that are going on between Europe and China, to say nothing of the fact that, of course, when there is a trade war between the US and China, maybe 60% tariffs, according to Donald Trump, all this other capacity from China could also flow into the European market. All of this stuff needs to be sort of discussed and figured out. And I'm very pleased that we're going to be able to talk to Paolo Gentiloni, because we're going to move away from the actual forecast and talk about some of the risks and have they modeled this stuff out, because that is going to be the big question for investors and really for everybody here in Europe.
Okay, Bloomberg's Oliver Crook, thank you very much indeed, passing the details that come through from the European Commission. And Ollie will be speaking, as he mentioned, to Paolo Gentiloni, the European Commissioner for the Economy. That's at 10:45 a.m. UK time, so certainly tune in for that interview. And Ollie was talking about the EV sector. We have a different line on that story right now, because Tesla and Rivian have extended their losses after a Reuters report that President-elect Donald Trump is considering dropping a consumer electric vehicle tax credit. Bloomberg's auto czar, Craig Trudell, joins us with the details. How likely is it then, Craig, good morning, that this subsidy, I should say, about a little over $7,000 US, the subsidy ultimately is pulled by Trump and the administration?
I think we can look at the Trump transition team's response to this report as, you know, essentially like, you know, why are you surprised here? They say, you know, Trump ran on this and he's essentially going to keep his promise to the American people. So.
Well, some people might say, well, we're surprised because Musk is part of the administration and he could lose out on this.
Yeah, I do think the way that the market has sort of piled into Tesla as a Trump trade, if you will, has been kind of remarkable, because you've seen a sort of rationalization of, well, maybe he'll be able to spare EV tax credits, or maybe he'll kill EV tax credits and that will hurt Tesla but won't hurt them as much as the other guys. And it's kind of all over the place, and I think, you know, sort of the depth of the analysis leaves a lot to be desired. I do think that when you look at who is you know, most affected this just on sheer volume, Tesla is far and away still the biggest seller of EVs in the U.S. They have the most consumers who are eligible for these tax credits. They will be hurt very significantly by this, whether Elon Musk wants to sort of admit it or not on his earnings calls. He has tried to minimize this, but I don't think he's made a very convincing argument for the idea that, oh, this will only just be, you know, a flesh wound.
Okay, no, that's really interesting. So you're very clear that Tesla will be impacted by this, because, yes, to your point, Musk has come out and said, look, we're better positioned, and he's kind of pushed for removal of these subsidies, which to some would seem counterintuitive, but you don't buy that argument that necessarily Tesla is in a better place than some of its competitors, that it can push back on some of the incumbents and allow it to hold that market share?
I think there's an element of the argument that he's making that does stand to reason, this idea that, you know, we're the only ones actually making any money making these EVs, so we can afford to sort of take this hit and our competitors would be devastated. there's some merit to that by all means. They are in a much better position in terms of scale and could potentially be able to withstand this from the perspective of a profitability standpoint. The problem he has is that these other car makers are still selling 80, 90, 95% or more of their vehicles are combustion engine vehicles, and those are making quite a bit of money, and Tesla doesn't have any of those. And so Tesla is still, in the sort of grand scheme of things, a small part of the market. It's also the case that Musk for years now has been emphasizing we need to make our vehicles more affordable. The reason that we're not growing like we used to is because our cars still aren't affordable enough. So taking away $7,500 from that equation and, in the sort of same breath of making that argument that our cars aren't cheap enough for people, it really doesn't sort of check out.
Particularly after Tesla's pushed through a number of price cuts as well. Is there an impact on European car makers?
I think there absolutely is, in the sense that, on one hand, if you're a Mercedes or a Volkswagen, you can't really pull back on your investments in the U.S., especially with, as you and Ali were talking about, the trade rhetoric and the tariff risk for these companies. You probably also want to be sort of hedged for the idea that after 4 years, are these fuel economy standards that Trump, again, potentially weakens, only going to get stronger again with a next president? You may want to sort of stay the course with the investments that you've already been making as well, and yet the rug's being pulled out from under you here, and so this is a real challenging sort of thing to confront if you're an executive in Stuttgart or Wolfsburg. How the heck do you sort of navigate this near term with a market in the U.S. that has been really all over the place policy-wise the last few years?
Yeah, you can imagine those European executives heads in hands saying, kind of, what gives? What next?
Do we do
Come
here?
on, this is it. We're already facing a list of challenges, and now we have another one. Craig Trudell, with the context around the reported cut to this subsidy for electric vehicles in the U.S., Bloomberg's car czar, of course, Craig Trudell. Coming up, we're going to break down the latest moves by hedge funds with Warren Buffett's Berkshire Hathaway cutting its position once again in Apple. That is next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Will Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back. Hedge funds have reduced their exposure to tech giants like Amazon and Apple. That's in the third quarter, at least, as the stock market rally broadened beyond big tech. That's according to Bloomberg analysis of the latest data from those 13F filings. Let's bring in Bloomberg's Charlie Wells, who's been poring over some of the numbers. The moves out of big tech, what does it tell us? What's been happening?
That's really interesting. I mean, this is really the moment when we get to look into that kind of time capsule of smart money. So this is all the filings that institutional investors have to make. And as you say, in that third quarter, we really saw them kind of rotate out of big tech. We have analyzed 1,007 of these 13F filings for hedge funds so far. If you think of names like Amazon, you know, holdings there decreased by $11 billion, so that's a big positioning away from there. We saw Warren Buffett's Berkshire Hathaway cut their Apple exposure by 25%. And it's also interesting when you look at some of the pickups, some of the big aggregate gains that a lot of these hedge funds added for some of these names. It's sort of like the new old normal. So you've got like Southwest Airlines, you've got Bank of America that they're picking up. Interestingly, financials were the largest increase in holdings for these hedge funds.
Right, that might have been good timing, given the financials done very well on the back of Trump's election. There's a redhead crossing the line right now from Alibaba, of course, that e-commerce giant in China, with that listing, of course, as ADRs over in the US. Said to be considering an offering of $5 billion of bonds, apparently within dollars and yuan. It could come as soon as this month, which reminds us that these hedge funds in the US also have exposure to Chinese stocks. Briefly, what's happening?
Well, it's helpful that you bring this up because Alibaba shows that there's kind of been a shifting play in how a lot of these large institutional investors are playing the world's second largest economy. So if you think about David Tepper of Appaloosa Management, he previously had said, buy everything China, right? That was kind of in the wake of that huge rally we saw in September. But actually, he trimmed his Alibaba holdings 5%, but that's still his largest holding.
Charlie Wells, brilliant as ever. Thank you very much indeed. The brief is up next. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of no. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning and welcome to our global headquarters here in New York. I'm Menace Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. Signaling a pause, the Fed Chair Powell calls the economy strong and sees no reason to hurry rate cuts as his colleagues remain cautious. I haven't had a boss in 25 years. A clear response from Jamie Dimon on President-elect Trump ruling out the JP Morgan CEO for his second administration as Treasury Secretary. Another controversial pick, Robert F. Kennedy Jr. is picked as Health Secretary, and John Thune says all options are on the table to get Trump's nominees cleared. Good morning. The art of the pause is on display in the bond market. I can tell you that. Yesterday we saw the very short end of this curve ramp higher by 8 basis points at one junction. We give a little bit back this morning. The December rate cut bets have been shredded from an 80% probability to barely over 50. And the line was this, the killer line was this. This is the art of the pause, or two-way optionality, I should say. The economy is not signaling the need for the Fed to hurry rate cuts. And with that in mind, up went the yields across the curve. Let's roll it over, because we're going to hear from Collins, Goolsbee, and Barkin today. So there's a little bit more Fed speak. Have a look at these equity markets. They're grappling with what a pause might mean for equities. Lots of people saying it doesn't matter about the rates. The growth is the most important narrative. In terms of the 13F filings, big is still very beautiful. The biggest weighting is in tech at 21%, followed by financials, 15%. And we've just seen the Bank of America flow telling us $55.8 billion went into U.S. stocks through November 13th. And it was a record for large cap stocks with $44 billion piling in. It is about the art of the pause, or two-way optionality. Fed Chair Powell spoke about his expectations for inflation and the path forward.
With labor market conditions in rough balance and inflation expectations well anchored, I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks to both sides. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Joining me now, Max Kettner, Chief Multi-Asset Strategist over at HSBC. The economy is not signaling the need for the Fed to hurry rate cuts. Is that the art of the pause, or just regaining optionality for December? Max, good morning.
Good morning, Manus. Thanks for having me. Look, I think it is more regaining the optionality because perhaps last week he's been a bit too one-sided, a little bit too much around, well, the labour market isn't really a source of inflationary pressure and we're totally fine with a soft landing, we're totally fine with a stronger than expected labour market, with stronger than expected activity. I think, you know, perhaps he's given up a little bit too much optionality without any clear need last week. So I think it's more regaining that, that optionality. But one thing is clear, Manus, that when we look at that, this is not signaling an end to the rate cutting cycle. So for credit, for emerging markets, for high beta effects, for equities in particular, and for equity valuations in particular, the real game changer would be if basically the Fed and Powell said, you know what, we've cut 75 bips, this is it. Growth is way too strong. We're worried about inflation. We're worried about core, about underlying inflation. This is it. This is not a pause. This is the end to the rate cutting cycle. That would be the game changer for risk assets. And that's nowhere near. We're nowhere near that. So that actually means, yeah, we might get those wobbles like we've seen in, yesterday and today in the futures, but those are actually your buying opportunities. Those are your buying opportunities where people, I think, freak out a little bit too much on the downside.
Well, you're stoic, and if nothing, you've been absolutely consistent in terms of your pro-risk stance. You look at momentum and you look at positioning, and the two things are conflicted for me.
Yeah, I think, however, funnily enough, when we look at positioning, at least on our measures, when we look at shorter-term positioning indicators, for example, equity betas of multi-asset funds, they're actually still not stretched. Funnily enough, they're still closer to sending a buy signal, and our overall signals, both from systematic and from discretionary investors, from options-based positioning, ETF-based positioning, real money positioning as well, what you've seen in the last couple of weeks was, despite the S&P going to all-time highs, despite global equity markets going to all-time highs, you know, things like high-yield credit spreads approaching the all-time tights, despite all that, we've always been consistently closer to a buying signal, actually. Right? We've been closer to a buying signal rather than a sell signal. Right now, that's still pretty much in balance. We're still seeing pretty neutral sentiment. So that still doesn't give us a particularly great warning signal that, you know, people are way too exuberant after the election result from last week.
Okay, and don't forget, there's now $7 trillion in money market funds, and one day, somebody will switch the gusher on, and those funds will come. Let's hope it's for all assets. I don't have any favorites. You talk about uncertainties behind us, and so it's re-risk again, it's increase your equities, your high yield, your credit. But Max, we're just about to launch into perhaps the biggest uncertainty territory of all, which is the size and the scale of tariffs, tax, and indeed deportations. Is the height of uncertainty not to come and not behind us?
No, look, I think two things on that. I think people confuse policy with politics a little bit at the moment. When we look at the policy setup is still one where we should be expecting more fiscal stimulus, where we should be expecting deregulation across various sectors in the US, where we should be expecting more rate cuts to come, where perhaps, for example, also in 2025, perhaps even in the first half of next year, quantitative tightening might be ending, you know, it might be ending sooner than some of us think, because there are some signs, at least, of some funding concerns popping up, particularly in the US. And all of that policy setup, which is ultimately what drives risk assets, which is what drives financial markets, that continues to be really supportive. So that's the one factor. The second factor is, because of these worries, because of these concerns around politics, ironically, what it does is it keeps sentiment in check. It prevents sentiment and positioning from becoming too exuberant. Because we've all got all these worries, we're all running, you know, across the street. We're all running these scenario analyses. What is it going to mean for inflation? What does it mean for Europe? What does it mean for China? What does it mean for growth in the US? All these kinds of scenarios. But what it really does is it keeps preventing investors from going full on and really max long risk. And that actually, from a sentiment positioning perspective, is a positive factor.
Listen, those models are running hard and hot. What's the most extreme kind of model that you and the team have extrapolated? What's your sort of worst nightmare for 2025 on some of that?
Yeah, look, I think when we go into 2025, the
the fact is that we don't actually know even what the sequencing is around it.
Yeah.
So I think what we've got to figure out first is, for example, what is coming in terms of sequencing. We could also argue that there's, perhaps something coming along
so
with
for risk,
the energy policy.
If in terms of sequencing, then, is it that if he doubles down, if Trump Mark II doubles down on tax first of all, rather than all a tariff war, that would be pro-risk rather than another headwind?
Yeah, I think so. When we look, for example, at the whole concern around tariffs, perhaps it's a little bit overblown. We don't also know whether that's, number one, whether that's going to come first. Number two, how large it's going to be. There's a lot of uncertainty attached around that. What we do know is, again, is the policy setup. What we have much more certainty around is the policy setup. We know that, the Fed is most likely going to continue cutting rates.
Yep.
Whether they'll skip December, whether they'll skip January. I mean, who cares at the end of the day? If you're a rates guy and you received or paid December and January, fine, that's your trade. But if you're long equities, if you're long credit, that's not really the stuff you care about. The policy setup is really what I think matters. At the end of the day, when we compare it, for example, to 2019, remember 2019, we also had global trade tensions. But what happened? The NASDAQ went up almost 40%. We had the S&P going up 30%. Why? Because real yields went down from 120 basis points at the end of 2018, and they went all the way down to negative. So if you had followed and focused too much on the politics side rather than the policy side, you would have made a massive mistake. So I would argue the policy setup is the much more important one going into 2025.
And as you very, very clearly have said here, we're not setting up to end rate cutting thus far. That is not the rhetoric that you take away from the Powell speech yesterday. Max, great as always, great context. I remain forever committed to the upside. HSBC's Max Kettner there, full bull. Trending stories on your Bloomberg terminal. This is what we got for you Friday morning. Hedge funds have reduced their exposure to the tech giants, the likes of Apple and Amazon in the third quarter. Now, that is based on the analysis of the latest 13F filings. Amazon holdings fell by $11 billion, and Apple decreased by 25%. Tech still accounted for the biggest weighting for the hedge fund portfolios at 21%. Meta says it intends to appeal court rulings that allow states and schools to sue social media apps over their contribution to the mental health crisis amongst the youth. Lawsuits were also filed against TikTok, Snap, and Google. Applied Materials gave a disappointing revenue forecast, signaling semiconductor customers may be holding off on orders. Now, despite the CEC remains confident, the CEO, remains confident that AI and new types of chips will keep the industry growing. Coming up on the show, Trump's cabinet continues to take shape. One notable absentee, Jamie Dimon. More on the top picks. And later this hour, we speak to Adam Posen on the economic impact of the President-elect Trump's immigration policies. Context matters on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate when your comps get tougher. How much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Menace Granny here in New York. Donald Trump's cabinet continues to take shape. One person who won't be joining it, though, is the JP Morgan CEO, Jamie Dimon. Trump shared a social media note that he respects Dimon, but that he wouldn't be invited to his next administration. Now, here's what Dimon said in reaction. He spoke to Bloomberg from the APEC CEO Summit.
First of all, I wish the president well, and thank you. It's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
Joining me now on Trump's cabinet picks, it is Bill Ferries. Bill, just very, very quickly, we still don't know who will be Treasury Secretary. Briefly, it looks as if it's narrowing down to Bessent and Lighthizer. Sorry, Bessent and Howard Lutnick.
Yeah, Donald Trump just several hours ago teased that he would have a big announcement coming on Friday in the U.S. We don't know if that's Treasury or something else, but Treasury is the big one outstanding. And it does seem that there's still a battle going on behind the scenes over whether it's Lutnick, Scott Bessent, or someone possibly like Lighthizer as well. We just don't know yet.
Yeah, I think the narrative and the betting seems to be around Bessent and that Lighthizer may come back in trade. One name that has been announced is RFK Jr. for Health Secretary. Now, that's the latest pick. It's certainly attracting attention, not least because we know his very strong and ardent views on vaccines. Just look at some of those vaccine stocks. They really tanked yesterday. But what do we know about his public health record?
Well, you know, he did start off as an environmental lawyer decades ago and earned a very positive reputation for that. During the campaign, Donald Trump said, after he formed this alliance with RFK Jr., he said he would let Kennedy go wild. That was his quote on the healthcare industry. Kennedy has been very skeptical of a lot of vaccines. He called the COVID-19 vaccine a crime against humanity. He would be very hard on the pharmaceutical companies, and I think that's why you see that market reaction today. It would certainly be, if it goes to a confirmation hearing, a very complicated confirmation hearing, just given his focus on his previous statements on healthcare policy in America.
Let's just frame this confirmation, the process to confirmation. If it is the Senate that goes through the processing of that, you're hearing from the recently appointed Thune, the new leader of the Senate. He's saying all options are on the table. And then you hear from John Cornyn, of course, who didn't get the job as Senate leader, saying we need access to all the relevant information by whatever means necessary. Of course, he's referring to Gates and those investigations into Gates.
Right, Matt Gaetz, Trump's pick to be Attorney General, overseeing basically the justice system. He has been the subject of a federal investigation that was dropped about a year ago, but the House Ethics Committee has been looking at charges that basically arose when he was accused of having paid for sex with a minor, having done some illegal drugs and things like that. The House Ethics Committee was due to release their report today, but his resignation, Gates' resignation from Congress, put that off. The Senate wants to get their hands on that report. That will be something that will certainly come out at least behind the scenes, before any confirmation hearing takes place. Matt Gaetz, the reality is he's not very popular among Republicans in the House or the Senate. There's a lot of people who are gunning for him, and I think he's probably the most difficult nominee at this point to see getting even to a confirmation process, let alone through it.
Okay, well, let's see what the big announcement is today. Bill Ferry's there on the very latest political appointments in the Trump cabinet. Coming up, a look at what else is making headlines around the world, including Buffett buying a slice of Domino's. More on the story in just a moment, right here on Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making. That's what we cover each week on our podcast, The Deal. I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're... Ready? Go.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Brief. I'm Manaskrani right here in New York. Front pages look a little bit like this, making headlines around the world. We kick off with the Journal. Berkshire Hathaway purchased small slice of Domino's Pizza. The 13F filings reveal that Warren Buffett's conglomerate took a position in the pizza chain. Berkshire also bought stock in Pool and has cut its position in Ulta Beauty. Next up, New York Times. Elon Musk met with Iran's UN ambassador. Iranian officials say this. Now, it's reported that they discussed ways to defuse the tensions between the US and Iran. This was on Monday. The meeting lasted over an hour and was held at a secret location. That's according to the Times. Bloomberg leads with the China stimulus boosting domestic consumption as the Trump tariffs loom. China's economy showed signs of balance in the fourth quarter, with consumption growth nearly catching up with factory output. What better man to talk to about this than Tom McKenzie. Tom, good to see you this morning. So it looks like there's a small recalibration by the consumer, and this is everything that markets wanted to see.
Look, Manish, you're absolutely right to focus in on the consumer, because that's the component of the China story that analyst investors have been looking for a turnaround, linked, of course, to the real estate and property prices, given of how much household wealth is invested in the property sector. We know the travails there, but you're absolutely right that retail sales is the standout data point of this otherwise mixed picture on the data front from China. So a massive pickup, or at least a significant pickup in retail sales, above all the estimates that had come through from the economists, suggesting that maybe China's consumer is feeling a little bit more optimistic. But I use the word mixed because the data on other fronts was still a little challenged. If you look at things like industrial production, that actually came in a little softer. And then house prices, month on month, continue to fall in terms of the house prices, but at less severe state, less extent, smaller drop than had been expected, certainly than previous months, suggesting that maybe the real estate sector is starting at least to have a floor put under it. Bloomberg Economics saying, look, we're not seeing a turnaround yet in this Chinese economy, but maybe the bottom is now in place.
We're tracking the 13F filings, the smart money, David Tepper and Michael Burry. It's interesting, Tepper, of course, going was buy everything. That was September. Is he still as bullish?
Yeah, it was a straight, clean call, wasn't it? Buy everything China in September. You saw the CSI 300 adding about 35% towards the end of September, early October, and now it's kind of flatlined and is trading in a range, the CSI 300. And what you're getting is a more nuanced picture from these 13F filings from Tepper and others. So Tepper actually trimmed his exposure to Alibaba and one of the ETFs that tracks China's large cap shares. Overall, his holdings of Chinese equities actually increased from 26% to 38%. But again, he did trim some of the holdings in Baba and some of the other large cap stocks within that ETF. Michael Burry, interestingly, increased his exposure to Alibaba. Didn't trim, increased, but added some options as well to hedge that risk. He did the same thing with JD.com and Baidu as well. He increased his holdings in Alibaba, by the way, by about 30%. But again, he's adding these options. So it seems like they're taking a bit more of a nuanced approach, hedging some of those risks, because, of course, one of the key risks going forward isn't just what happens with the economy and the data that comes through and the stimulus on the monetary policy front, the fiscal front, but also, of course, what the incoming Trump administration does in terms of further restrictions on that economy and on trade flows to China, and how that will ripple across the world's second largest economy.
And I think that one of the big issues in that, Tom, is going to be what happens to the currency and whether the tariffs have the same. Just have a look at the IIF article this morning. It's great. It's the scale of the reaction function of the drop in the yuan this time around relative to the tariffs the last time around. They don't think it's going to be just as aggressive, but I don't think anybody really has the complete answer to that, do they, Tom, just yet? Tom McKenzie, Bloomberg Daybreak Europe anchor, joining me this morning. Coming up, a conversation you don't want to miss. Adam Posen at the Peterson Institute on the economic impact of the President-elect Trump's immigration policies. Context matters on Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community, and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manus Cranny. Let's set your agenda. Signaling a pause, Fed Chair Powell says the economy is strong and sees no reason to hurry rate cuts as his colleagues remain cautious. I haven't had a boss in 25 years. A clear response from Jamie Dimon on President-elect Trump's ruling out the J.P. Morgan CEO for his second administration as Treasury Secretary. And a controversial pick. Robert F. Kennedy Jr. is picked as Health Secretary, and John Thune says all options are on the table to get Trump's nominees cleared. Good morning. Ground zero for reaction is the bond market. We will hear, of course, from Collins, Goolsbee, and Barkin later today. But the market, in the very first instance, repriced on this one line from Jay Powell, the chair. I put it down as the art of the pause. Max Kettner disagrees with me. He doesn't think the Fed is going to pause. The one line is the economy is not signaling a need for the Fed to hurry rate cuts. I put it down as regrasping, recalibrating the narrative from the chair. Roll it over, have a look at the stock market. It struggled a little bit with this pop in yields yesterday. You need to ask yourself this. HSBC, cross-asset Max Kettner, is still unashamedly bullish on this. He does not see positioning as stretched. He sees policy being more important than politics. And the policy is still dovish, it's still stimulatory, and to that extent, yes, maybe politics will restrain some of our exuberance, but policy is the alpha in the room, and for him, policy remains something that you want to be long of risk. 13F filings, big is still beautiful. Tech is in there at 21%, holding on the 13F filings, and the money flowed into U.S. stocks up to November the 13th. $55.8 billion flowed in. We give a little bit back this morning. NASDAQ, you've got the likes of Tesla and Rivian really under pressure yesterday. That was more as a result of the EV credits, the discussion around the possibility that the Trump team planned to kill the EV credits. We'll keep an eye on those EV makers. I spoke to Adam Posen, it was June, and we talked about the economic impact of President-elect Trump's immigration policies.
What this would mean for the economy is a manufacturing-centered recession. And inflation would go up, so it would actually be stagflation, but the inflationary effects would then be outweighed by the recession.
Joining me now, it is Adam Posen, president of the Peterson Institute for International Economics. Adam, welcome back to Bloomberg TV. The political dial has moved on since you and I last spoke about deportation, immigration, tax, and tariffs. I want to drill into the immigration side, the supply side of this economy, Adam, because the risk is this, that it can be a much bigger deportation perhaps than was originally estimated, and I want to get a sense from you how quickly this deportation process will be undertaken. Good morning.
Good morning, Manus. Thank you for having me back, and most importantly, thank you for bringing top of mind again the issue of the economic impact of the Trump administration migration policies. I think that is not getting enough attention, and I was glad you and I were able to draw an initial attention to it some months ago. The point is, as we at Peterson and I have been forecasting, The migration issue is not quite like the tariffs issue or some other issues where the Trump administration can say, oh, this is just a negotiating stance. And the reason for that is twofold. First, there's so much domestic political demand, which is part of why he got elected, to take action. But second, there isn't like a government that you're negotiating with where the deal gets done. The whole point is to scare employers of undocumented migrants and to deter migrants from coming to the U.S. And so what they are likely to do, as we've discussed, is 30, 40, 50,000 migrants, ostensibly with criminal records, although some of those crimes are misdemeanors and who the hell knows what they're going to pick up, and marching them across the border into Mexico on TV. And then what Stephen Miller's planning is building up private prisons and internment camps in the Southwest. And this is all meant, arguably, rationally, to signal to people, don't hire these migrants, you're going to lose them, migrants don't come. The difference is that they can feasibly do that, and then they scare people. But then they have to keep moving forward to make sure that it's credible they're really going to do this. Doesn't mean 1 million people necessarily, but it could mean easily a few 100,000, and that's very feasible.
Okay.
Finally, on the practical side, sorry. The key point is that I overlooked something when we last spoke, which is the impact on the housing supply. You're right to call this a supply side shock, and it will be felt there as well as manufacturing.
I'm interested because when we last spoke, the bandwidth, Adam, from the Institute was 1.5 to 7.5 at extremis. What is the real risk here? You're now, my sense is you're recalibrating the size and scale.
Not that much. What we did was we did the simulation at 1.5 to 7.5 million deportees because that was what was in the platform and statements that various Trump, either the president-elect or his surrogates had said. So we were just taking them literally. We're recalibrating in two senses, or I'm recalibrating, I should say, in two senses. The first is we talked about this, but we couldn't study it, which is how do you estimate what the fear effect is if you deport tens of thousands or a couple 100,000 rather than 1 million? It's not going to be only a few percent of deporting a few million, but it's obviously not going to be the same as deporting a few million. So that's one point.
Adam,
the other point, as I mentioned, is the housing market.
Okay, we've got a lot to pack in. Sorry to hurry you along.
No, sorry to go so long.
Not at all, not at all. It's good to get context, and that's the important thing here. Briefly, is still base case stagflation rather than an inflation bump?
Base case for the migration effects is stagflation. Base case for tariffs, for energy deregulation, for fiscal indiscipline, including unfunded tax cuts, all of those are inflation without necessarily stagflation. In fact, as my colleague Olivier Blanchard has argued, and I largely agree, there is room for there to be a boom-bust cycle under Trump if he gets to pursue particularly the fiscal policies. But the migration is the different one, and that's where I disagree a little bit with Olivier and some others. I think that's where there's a risk that if they overdo it in economic terms, you get stagflation as well instead of a boom-bust.
Adam, let's go. I'm calling it the art of the pause. I've already had HSBC knock me down. The economy is not signaling a need for the Fed to hurry rate cuts. Chair Powell, is that regrasping two-way optionality for the Federal Reserve, or is that, in your mind, recalibrating towards a pause?
I think he thinks it's the latter, and he's failing at the former. Meaning, as you and I again started talking about months ago, I've been calling that the Fed was setting up too many expectations for ongoing rate cuts, irrespective of the election, because they overestimated how tight they were and underestimated the strength of the economy. And then said they should have been preparing people because both Harris and Trump were going to do fiscal excess. So now he's stuck. He browbeat people into doing a 50-point basis cut when there was no need. The economics are pushing against continued cuts into 2025. I think your apt description is what he's trying to pull off, but it doesn't really matter whether the cut's in December or January. They're going to pause cutting some point early in 2025. And that's going to be just vindicating the way the long end moved in the markets.
Okay, so that's the interpretation. I do want to get your opinion on one thing. It's a brilliant phrase. A lot of people have sent me messages on the hegemony and the dollar's exorbitant privilege. Given the landscape of policy that we don't know the details on yet, but we think it's going to be a bumpy ride, do you see capital outflow from the U.S. economy as opposed to massive inflow? Because that impacts the exorbitant privilege of dollar.
Absolutely. I see massive inflow because even if when it's the U.S. causing geopolitical instability, let alone trying to force people to invest and pay the government, capital flows into the U.S. I see our inflation and our tariffs pushing up the currency and put interest rate. My interest rate calls also obviously dollar strong. I see Europe and China both being weak in cyclical terms and structural terms. So the good news from the Trump sweep, the Republican sweep, is he's more likely to behave in a constitutional manner. And that would have been unconstitutional fiscal attempts against, say, if there had been a Democratic majority House, that would have undermined the dollar. But if he's staying within his majorities and legal barriers, I expect the dollar to go very strong for a couple of years.
Adam, always great to get your perspective. Thank you for joining me on Bloomberg Brief. That's Adam Posen of the Peterson Institute for International Economics right here on Bloomberg. Good morning from New York.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like this redefine a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It is your Bloomberg Brief on a Friday morning. I'm Manish Granny here in New York. Donald Trump's cabinet continues to fill up. One person who won't be joining it, though, is JP Morgan CEO Jamie Dimon. Trump shared on social media that he respects Dimon and that he wouldn't be joining his administration. And here's what Dimon said in reaction. He spoke to Bloomberg at the APEC CEO Summit.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
Joining me now for more on the Trump cabinet picks is our Bloomberg senior editor, Mike Shepard in Washington. Mike, there you go. Very, very graceful. You know, I haven't had a boss in 25 years from Jamie Dimon, and I'm not about to start now. Of course, we're still waiting to hear who the Treasury Secretary will be. I mean, Trump, he took care to mention that he won't be inviting Jamie, and it was very, very graceful and elegant response from the two of them. What are we down to?
Well, we are down to now 3 based on our latest reporting, but keep in mind there are always wild cards, and we have seen these crop up through the selection process, which is unfolding so rapidly right now from Trump's Mar-a-Lago resort in Florida. So the 3 odds-on favorites are Scott Bessent of Key Group, a hedge fund manager. We're also looking at former U.S. Trade Representative Robert Lighthizer, who had spearheaded the administration's tariffs and trade policy during Trump's first term, and then Howard Lutnick, who's the CEO of Cantor Fitzgerald, and he is somebody who was helping to oversee the Trump transition and has a bit of a window into everything that Trump is thinking about as he pulls his team together.
Well, he maybe is the one in the room at the moment, as a number of people have said to me in terms of the narrative he's there bringing in the staff. RFK Jr., excuse me, RFK Jr., Health Secretary, is the latest pick to attract some attention. Now, of course, conspiracy theories, we know that he's not a fan of vaccines. A lot of the vaccine stocks came under pressure yesterday. Trump says he will restore the gold standard in scientific research and beacons of transparency. So what exactly are his views on health?
Well, in a word, they're unorthodox, and that is drawing concern from across the healthcare and medical research establishment. You know, we talked to a number of people as RFK's presidential campaign. Remember, he ran as an independent, came together where a lot of these views came out. It's not just his skepticism on vaccines. He has also called for removing fluoride from drinking water systems around the country, and that defies more than 80 years of consensus on oral hygiene. So things like that are causing a lot of concern, including on Capitol Hill, where lawmakers in the U.S. Senate will have some say over whether he should be confirmed as Secretary of Health and Human Services. And remember, Manus, this is a big job. Yeah. He oversees more than 100 public health care programs and research initiatives with a lot of influence. You mentioned the stocks, the vaccine makers' stocks. Mm-hmm. He would have enormous influence over the pharmaceutical industry and other businesses as well in this role.
Look, we've got RFK and Gates up for approval, along with others. My sense is this, that from the Senate, you've got a newly appointed Senate leader. All options are on the table. But it sounds as if this Senate really does want to have its voice. If you look on Matt Gaetz, some of the people in the Senate there are talking about, you know, John Cornyn. I know he was up for the job, but he's talking about making a subpoena for the information on Gates and the investigations.
Well, that's right, Manus. They are looking for regular order on this. The president-elect has really made clear he would like his nominees to get through as quickly as possible, even if it means the Senate takes some shortcuts. And while leaders there may be interested in cutting a corner on 1 or 2 of the nominations to help Trump out, on RFK Jr. and on Matt Gaetz, who is Trump's pick to be Attorney General, that may be a bridge too far. Matt Gaetz in particular is someone who will demand a lot of scrutiny. He has been facing a recently closed House inquiry into allegations of sexual misconduct, and he also happens to be one of the least popular members in the U.S. House right now. Even his own colleagues have complained publicly about his behavior on the House floor, and there's also a lot of resentment over the role he played in ousting former Representative Kevin McCarthy as House Speaker. So a lot of that tea will want to be spilled as senators consider whether to advance him and approve him as Trump's Attorney General.
Okay, well, let's see whether there is a big announcement today, Shep, and whether it is trade or Treasury Secretary. That's what the markets really are focused on. Mike Shepard there in Washington. Just a quick correction for you. A little bit earlier, we said that on the hedge fund 13F filings, they had been pulling back on their tech holdings. Well, Amazon holdings fell by $11 billion. It was Berkshire Hathaway that cut their Apple position by 25%, not the hedge funds more broadly. That's it. We'll have a little bit more for your trading day ahead. We're waiting for more Fed speak to come throughout the day. Collins, Goolsbee, and Barkin. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg. I'm Oliver Crook here in Brussels. We have just got the newest sort of edition of the European growth and CPI figures brought to us by Paolo Gentiloni, who is the EU Commissioner for the Economy, and he joins us here on set now. Mr. Gentiloni, thank you so much for your time today. So you've put out these forecasts. We're coming back to growth next year. Inflation is coming down to 2%. It seems to me that these are some of the most fragile and vulnerable forecasts that we've ever had because we know something is coming from the Trump administration. What are you expecting?
Well, from one side, we are satisfied of the fact that after a 2023, which was stagnation, zero growth, we have now a moderate growth, of course, with different situation in different European countries. We still have the larger European economy, which is Germany, with negative activity. But overall, the famous soft landing is, I think, there. Same time, we'll have to face the new situation with this historical victory of President Trump. I don't think that now we can speculate on the decision that will be taken.
But he has said 10% or 20% tariffs. When you hear those numbers, what kind of impact do you imagine on the European economy?
I think that we will, of course, address the measures if and when they will be taken. Overall, our point is we are referring to a trade flow of 1.4, 1.5 trillion, which is the most important economic flow in the world. And it is a flow among partners, allied. So to compromise this, I think, is something that nobody has in mind, because if you compromise this, the impact will be, of course, in the European economy, but also in the American economy.
Do you think that this could endanger the sort of CPI hitting 2% next year, hitting that target? Do you think that that puts it at risk, these tariffs?
Well, if these tariffs will be decided, they could have an inflationary impact, in particular in the U.S.
Do you think for the new commission, we've been hearing from Mario Draghi, he's talked about the slow agony of decline of Europe if it doesn't get its act together. Macron has talked about the death of Europe. In your speech just now, you said part of the answer must be new common European financing instruments for common use. What new instruments are you referring to?
Well, we had an experience, unprecedented, 800 billion euros of common funding with Euro bonds. I think the financial markets prove that this is doable, and I think that this could be repeated. Where and how? I think the first attempt could be on common defense. And in my view, the fact that President Trump was elected with such a strong majority can also prove to be a wake-up call for the Europeans, especially on defense. So common funding for
do you think there's the political space for common funding on defense?
Think there is. And what in our Brussels language we call the frugal countries,
yes,
those that are more reluctant for common funding, are less reluctant on common funding for common defense. And so I think there is a way.
And I'd like to understand also what part the trade war potentially between Europe and China. We have obviously this dispute over electric vehicles. We have seen some retaliatory measures. What part does that take into your projections?
Well, here I think we should consider two things. First, that the European Union left his traditional ingenuity in the trade relation with China in the last 2 or 3 years. This was not the situation 10 years ago. We were hoping and expecting an unlimited growth in trade with China without many conditions. Now we are putting conditions. If there is overproduction and subsidies, we are reacting. But at the same time, don't forget the fact that for the European Union to keep open the global trade is a vital interest. Yeah. And so we will not close the doors to a protectionist way.
And very quickly, is it easy for you, if, say, Trump comes in, he says 10% tariffs across the board, is it easy for you to calculate what impact that has, or are there a lot of unknowns in those models?
Well, there are a lot of unknowns. What is clear to me is that the impact would be for both economies, both Europe and US. And this is a more reason, an additional reason to consider these things not as a given, but to start a conversation and cooperation, and this is what the European Commission will do with the new administration.
Well, Paolo Gentiloni, thank you so much for your time, the EU Commissioner for the Economy here in Brussels. Manus, with that, I'll hand it back to you in New York.
Oliver, great conversation there. The risk is, of course, to blow back tariffs here to the United States of America, and that has consequences for growth, for inflation, and as we heard from Adam Posen, the risks for stagflation 2025. That was Oliver Krug with the EU Commissioner, Paolo Gentiloni. I'm going to leave you with a snapshot of what's going on equities. The surveillance team will take you through the machinations of the markets. This is an equity market which has given back pretty much a third of its peak, trough to peak rally since the election. We nip a little bit lower this morning. Electric vehicles will be in focus again. S&P 500 down by 0.6%. Good morning from New York.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was...
Is this the best time ever to be starting a technology company?
Let's at least say it's the best time yet. Hopefully there'll be even better times in the future. I sort of think with each successive major technological revolution, you've been able to do more than you could before. And I would expect the companies to be more amazing and impactful and everything else. So yeah, I think it's the best time yet. Big companies have the edge when things are like moving slowly and not that dynamic. And then when something like this or mobile or the internet or the semiconductor revolution happens, or probably like back in the days of the Industrial Revolution, that was when upstarts had their edge. So yeah, this is like, and it's been a while since we've had one of these, so this is like pretty exciting.
In the essay, you actually say a really big thing, which is ASI, superintelligence, is actually thousands of days away.
Maybe. I mean, that's our hope, our guess, whatever. But that's a very wild statement.
Yeah. Tell us about it. I mean, that's big. That is really big.
I can see a path where the work we are doing just keeps compounding, and the rate of progress we've made over the last 3 years continues for the next 3 or 6 or 9 or whatever. 9 years would be like 3,500 days or whatever. If we can keep this rate of improvement or even increase it, like that system will be quite capable of doing a lot of things. I think already, even a system like O1 is capable of doing like quite a lot of things from just like a raw cognitive IQ on a closed-end, well-defined task in a certain area. I'm like, O1 is like a very smart thing. And I think we're nowhere near the limit of progress.
I mean, that was an architecture shift that sort of unlocked a lot. And what I'm sort of hearing is that these things are going to compound.
We could hit some like unexpected wall, or we could be missing something, but it looks to us like there's a lot of compounding in front of us still to happen.
I mean, this essay is probably the most techno-optimist of almost anything I've seen out there. Some of the things we get to look forward to, fixing the climate, establishing a space colony, the discovery of all of physics, near limitless intelligence, and abundant energy.
I do think all of those things, and probably a lot more we can't even imagine, are maybe not that far away. And I think it's like tremendously exciting that we can talk about this even semi-seriously now. One of the things that I always have loved the most about YC is it encourages slightly implausible degrees of techno-optimism and just a belief that like, you can figure this out. And, in a world that I think is like sort of consistently telling people, this is not going to work, you can't do this thing, you can't do that. I think the kind of early PG spirit of just encouraging founders to like think a little bit bigger, it is a special thing in the world.
From 2 very different Chairman Powells, that one in Jackson Hole, Wyoming, and another one in Sintra, Portugal, when he talked about the strength of the economy being a reason to take our time to get this right. Just had echoes of that just yesterday, which is why we've got Evercore, the likes of Evercore and others this morning, saying the following: a December rate cut is not a lock.
And that's why you have the market responding to this. I think we got over our skis in putting the emphasis on the election and what that meant for the bond market. Yesterday was the perfect example of how that kind of trade can backfire on you. Basically on the curve, you had the exact opposite that you had seen the day before. And so this reinvigorates the trade. The idea that inflation is a problem for the Fed and the labor market is looking healthy.
We are hyper data dependent. A little bit later this morning, we get US retail sales, payrolls December 6th, CPI December 11th, that Fed decision December 18th, and hopefully between now and then, we actually find out who's going to lead economic policy in the Trump administration, because we have had all of these picks, and we can talk about them later in the program. We're still waiting for Treasury Secretary and the director of the NEC.
It's interesting because you think this would be one of the first names Trump actually comes out and goes on Truth and says, this is the individual I'm going to have lead this economy. Because why? He ran an economic agenda. He ran a campaign where he was talking about the economy. He was talking about the fact that inflation was high under the Biden administration and those price levels have not come down. Yet, we are still waiting in the wings to decide who is going to lead the Treasury.
We know who it won't be. Jamie Dimon. Was it ever going to be Jamie Dimon?
I saw that Truth Social and I was like, where is this coming from? Because we've seen this story before. He's already come out and said Jamie Dimon will not be my Treasury Secretary. Yesterday was Jamie Dimon will not be in the administration. Jamie Dimon quickly to Lisa saying, thank you for the note, but I don't have a boss for 25 years. I don't plan on having one. But I wonder what shareholders think of that, Jonathan. No boss?
More on that story a little bit later. I think they feel like they might be his boss. Equity futures on the S&P 500 right now, we're down by 0.6%. In the FX market, the euro's been weak. Just a little bit of strength this morning. We're up by 0.4%. Euro dollar 105.73. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley, looking for a rebound in M&A. We'll speak to Maya McGuinness of the Committee for a Responsible Federal Budget on Trump's to-do list, and Greg Mellick of Evercore ISI, ahead of earnings from Walmart and from Target. We begin this hour with stocks falling after Fed Chair Jay Powell signaled the central bank is in no rush to cut interest rates, and investors continue to weigh potential Trump policies. The team over at Morgan Stanley looking for a Trump-driven M&A boom, writing the following. U.S. election points to higher probability of a bull case outcome. Our base case is a 50% year-over-year increase in M&A announcements in 2025, with our bull case a larger 78% increase. Andrew Sheets of Morgan Stanley joins us now for more. Andrew, welcome back to the program, sir. Great to catch up with you following the election win for President-elect Donald Trump. I want your opinion now, Andrew, on what underpins that M&A boom. What are the policies that you're looking for that changes the story?
Yeah, thanks. Good morning. It's great to be here with you. So I think this is about some underlying positive trends for M&A now meeting some other more recent catalysts. I think if we take a step back, M&A is all about confidence. These are transactions that require a company to really believe in the outlook for several years in advance. And we've been through a period of a lot of economic volatility and uncertainty around how much would inflation rise, how much would interest rates rise, would central banks ever start to cut, and if so, how much? Would the economy go into recession, which was a widespread fear last year and even for a lot of this year? And so I think in the background, you've had a lot of these macroeconomic uncertainties be resolved or look a lot better. And yet M&A has really lagged the strength you see in the economy, the strength you see in markets. And so one reason maybe why that gap still exists is there's still been lingering political uncertainty. Obviously, the U.S. election was a well-known event, an uncertain event, but with it passing, and I think with a lot of companies, we think we'll see the new administration as one that will be less regulatorily focused, more somewhat encouraging of animal spirits. We think that could be another further positive catalyst for more M&A.
Andrew, you cover credit. I think an important question in your world is how that M&A will be financed. How are you thinking about that?
Yeah, so another important element is you have willingness, we think, which will come from more confidence in the economic backdrop, maybe more confidence in regulatory policy, but also ability. Quite a bit of dry powder that's out there. So our colleagues estimate there's around $4 trillion of dry powder from private market investors. We think there's another $7.5 trillion US dollars equivalent sitting on non-financial balance sheets. And then you also have financing markets that are wide open. You've seen, $1.5 trillion of new issuance in the IG markets this year in the U.S. You've seen very low new issuance premiums, which suggests that investors are taking down that supply pretty happily. And I think you're at a level of yields which are still high enough to attract bond investors, but on the larger view are kind of roughly at the 100-year average, not scary for corporates, we think, in a material way. So kind of wide open financing markets, I think, are another important part of this story.
Does the mix stay the same, Andrew? Because if you have something like a junk bond, you can also go to the leveraged loan market. You can do high yield bonds and increasingly private credit. Does having the market open up in a more friendly M&A environment move us back towards what was the norm and going to the junk market?
Yeah, we do think we'll see more activity there, and also I do think that you have a backdrop where, as you mentioned, I think private credit will be an important part of this. Private credit has already been extremely closely linked and extremely important to leverage buyout activity over the last several years. If we think that leverage buyout activity resumes and increases, and we think it will, then that would also suggest an important role for private credit, and that's also a market with its own substantial amount of dry powder. And I think the strategic side is also important here. You also have, we think, kind of a significant amount of assets on private equity balance sheets or holdings that private equity will want to dispose of. These are quite mature assets that have been held for longer than normal. And I think the desire to look for a strategic buyer to those assets, especially when those strategic buyers have a very wide open corporate bond issuance market to finance through, is going to be a source of more activity.
Andrew, one of the other reasons, besides maybe stricter regulations, as to why we didn't see M&A was just higher rates. And yesterday we heard from a Jay Powell who seemingly gave himself the optionality to pause in one of the next upcoming meetings. How big of a risk of that is that if we see rates that stall out somewhere around current levels?
Yeah, so I think that issue of why rates are staying higher is incredibly important. I think as Chair Powell phrased it, he was very focused on the strength of the economy. And I think if rates are staying more elevated because the economy is strong, well, when did we see the highest M&A of prior cycles? 98, 99, 2000, or 2006, 2007, those were both periods with quite high interest rates, quite frankly, and quite high economic optimism. So I do think that there are plenty of historical examples where you can get more corporate activity at higher rates because there's confidence in the economy and because that confidence is starting to unlock more animal spirits. Now, if interest rates are staying higher because inflation resumes, or maybe because of tariff policy that drives higher prices, that might be different. And so I think we do have to stay focused on why rates are moving or staying elevated. But if they're staying elevated because the economy is strong, and I still think that's still the story through the first half of next year, I think that could certainly correspond to still healthy M&A volumes.
You mentioned potential tariffs. Another political policy could be immigration policy. What kind of effect would that have on growth? And then is that a potential risk to this M&A boost you're expecting to see?
It would have a significant impact on growth. And again, I think one of the challenges of modeling major changes of immigration policy or even deportations is there's not much precedent for it in terms of thinking about the economic impact. And so the economic impact can be severe. And so I do think where markets are right now is maybe you could say in the easier phase of the optimism curve when, no policy change has yet been implemented. And so kind of all options are still on the table. But I think as you move into 2025, whether or not many of these policies actually get implemented as stated is going to be incredibly important. And is something that I think investors everywhere, ourselves included, are going to have to be reactive to. We're going to have to adjust our views as those policies change. I think this is also, though, important that, M&A is not just, in our view, a U.S. story. We're encouraged by the European Commission, which has taken, we think, or is going to be taking a more open view towards M&A in terms of encouraging more regional champions as you get maybe a little bit more of a multipolar world. There's still an important M&A story in Japan as it's embracing shareholder returns and corporate efficiency, and it does extend to other regions as well. So this is still a global story, even if I think the U.S.
What clients are saying about Europe right now, credit spreads in America are super tight. Everyone wants a piece of the action at the moment. You talked about the animal spirits unlocking some real optimism about growth going forward in this country, at least for now. How easy or how difficult is it to sell the European story to clients at the moment?
Yeah, the European story has become more difficult, if I'm honest. I think Europe is facing increased uncertainty. It's been facing increased uncertainty on geopolitics with the new U.S. administration. It's facing more uncertainty on growth and tariffs. And, Europe went through this year with a weaker economic story, weaker growth, higher inflation than the U.S. did, a weaker macro backdrop to start with. So, I do think there is some valuation support. European equities, on a variety of ways you measure it, trade unusually cheap to the U.S., even adjusting for the usual discount. European credit trades at a discount to the U.S., but given those uncertainties, it's harder to close those gaps than I think it would have been before or under kind of different outcomes. And so I do think that's going to lead investors to be more focused and more favorable to the U.S., at least for the time being.
The election was a real game changer. Andrew, it's good to catch up, sir. Thank you. Andrew Sheets there of Morgan Stanley, looking for a boom in M&A. Equity futures right now on the S&P 500 attempted to bounce. We're still lower. We're down by 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahira Hacker. Say, Yahira.
Hi, John. The Biden administration finalized a contract with TSMC to give the chipmaker over $6 billion in grants to bring production to the U.S. The chipmaker already reached some benchmarks and will earn at least $1 billion of the total amount this year. TSMC will also take up to $5 billion in loans. The award is part of the CHIPS Act aimed at boosting domestic semiconductor production. Meanwhile, Meta Platform saying it intends to appeal court rulings that allow states and school districts to sue the company over claims its apps are contributing to a mental health crisis among kids. The tech giant saying it will ask the Ninth Circuit Court of Appeals to review orders last month by a California federal judge who rejected the company's request to dismiss the complaints. The lawsuits brought by the school district were also filed against TikTok, Snap, and Google. And it's official, New York is bringing its congestion pricing plan back. Governor Kathy Hochul is looking to push through a revised tolling plan, charging drivers $9 to drive into Manhattan's major business districts. Hochul plans to implement the new change on January 5th before President-elect Trump takes office. Hochul introduced the congestion pricing plan with a $15 toll earlier this year, but with elections looming, she paused it, citing the financial pressures it would put on working families. That's your Bloomberg Brief. John?
And just like that, bang, the financial pressures disappeared because the election has passed.
Well, she's coming under fire from President-elect Trump. He says he has great respect for the governor, looks forward to working with her, but I strongly disagree with the decision on the congestion tax, so I don't think this is going away.
He's not the only one. Up next on the program, Jamie Dimon is out of the running.
I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
Was he ever in the running? That conversation up next. Live from New York this morning. Good morning.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The next up for this market, US retail sales, 8:30 Eastern Time. Going into that, equity futures lower. We're down by 0.6%. In the bond market, yields down just a basis point, 442.76. Under surveillance this morning, Jamie Dimon is out of the running.
I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start. The most important thing is whoever had been elected, and this is my belief, they are entering and can be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best.
So here's the latest. President-elect Donald Trump rolling out Jamie Dimon for Treasury Secretary, writing, "I respect Jamie Dimon greatly, but he will not be invited to be part of the Trump administration. I thank Jamie for his outstanding service to our country." The two frontrunners remain investor Scott Besson and CEO Howard Lutnick. Maya McGuinness of the Committee for a Responsible Federal Budget warning the to-do list for them will be long. Given the enormous fiscal challenges in the near future, including critical deadlines, the role of the Treasury Secretary will be more important than ever. Maya joins us now for more. Maya, welcome to the program. Always fantastic to catch up with you once again. Walk me through those critical deadlines. How big are they? How many are there?
Oh, there's so many things that whoever becomes the Secretary of Treasury will be inheriting. First off, they're inheriting a terrible fiscal situation, the worst we've ever had during peacetime, and it's about to be the worst we've ever had in the entire country. On top of that, we have these huge expiring tax cuts coming up next year. We have trillions of dollars of new promises that President-elect Trump has made in terms of things that he wants to implement. And we have things like the debt ceiling, which have been huge tussles in Congress before, leading us to some very scary deadlines when you're talking about the potential default. I think with a sweep of Republicans, that won't be as much of a problem. But there are a number of people who don't want to increase the debt ceiling and cast that vote no matter what. So the economic situation, which so far has been remarkably sort of safe as we've gotten out of the inflationary situation, is going to have many things that the new Treasury Secretary and President are going to have to navigate. And then when you look at the layers of promises, which would grow the debt, complicated policies like tariffs, this is not going to be an easy situation.
Promises don't always mean policy, though, as we know in U.S. politics. The top two contenders John talked about, Howard Lutnick, Scott Besson. What do you make of these two picks? Or if you don't really know them that well, what kind of characteristics are you looking for in someone that can really guide through all these to-do list agenda items that you've just outlined?
Yeah, exactly. I don't know either of them well enough at all to make any specific comments on how they would be. I know they're both incredibly well-respected, well-regarded. I think an important thing is going to be the ability to push back in some of the president's desire to say yes to everything when it comes to fiscal policy. President Trump is a known entity. We've seen him before. And when he was in the White House last time, he really liked tax cuts, but he also really liked spending increases. And one of the things that we're going to have to grapple with is the trade-offs or the choices this time. I assume that they are going to extend the tax cuts. They need to figure out a way to offset those costs so they don't add $5 trillion to the debt, which is the projected cost. That could be from other revenue raisers or spending cuts, which would be something you would think a lot of Republicans would support. But I think the Treasury Secretary is going to have the role of really talking about why that's important. Second, I think the issues of tariffs are obviously an incredibly complicated policy, where if you think about how they affect the economy, how they affect fiscal policy, and or how they affect national security, you come up with different takes on tariffs for each one of those. So explaining, or not explaining, I'm sure the president understands, but going through the trade-offs and the nuance of all of those in conjunction with the rest of the things that are going on in the economy, I think will be the role of the Treasury Secretary and the entire economic team. But it's President Trump has liked to have a diverse cabinet of diverse opinions. I really hope there is somebody in there who is pushing for fiscal responsibility, but also not just using the short-term metric of the market performance or short-term growth from borrowing, but looking at the long-term health of the economy. And as Jamie Dimon just said a minute ago, the geopolitical and the geoeconomic situations are really the most tenuous we've seen in decades. There wasn't sufficient discussion during the election, really, of the overall vision of how to contend with those. And that's going to have some real risks for the economy that you want somebody who's sophisticated and savvy.
Maya, when it comes to cutting spending, it brings me to DOGE, which your group put out a statement yesterday, and you said, we welcome the creation of this new entity to get under the hood of the federal government and look for ways to reduce inefficiencies. You say this effort is long overdue. Maya, can you name a single task force in the past that has actually been successful at cutting the budget?
Yeah, you know what we've seen, the answer is no at the time, and I am not optimistic about our political class doing anything hard right now. We need to raise revenues, we need to fix entitlements, we need to cut spending. We know all this. These things don't happen through regular order or through commissions. But what you do see is a lot of commissions, from Simpson-Bowles to the Grace Commission to Reinventing Government, that put out a lot of ideas that are on the shelf and sometimes get pulled off then about things that you can do later when you're looking for offsets. But quite frankly, when our Congress and the president look at how to cut spending, they always end up just relying on things like discretionary spending caps, which means they don't have to pick the actual choices, the actual spending cuts. The reason is there's a constituency for every program out there, and they're hard to push back on. But we desperately need to lift up the hood and look at a lot of places where we could certainly be both more efficient and cut outdated, inefficient, unnecessary spending, because our budget is absolutely bloated and we're not willing to pay for what we have, which means we continue to borrow more.
Maya, where would you do that? If you were to advise Ramaswamy and Musk, where would you tell them to look?
Well, I would tell them to look exactly where President Trump during the campaign said, don't look. But our biggest programs, our biggest problems, the industries are healthcare, national security, and tax expenditures, spending through the tax code. That's where you're going to find the biggest amount, trillions of dollars of waste over a decade, not in a single year, but over a decade. But I think you also have to look at our biggest programs for whether we really should be paying for those priorities. Social Security, we know, is headed towards insolvency in less than a decade. It would be great if somebody would be willing to talk honestly about the need to reform that program so it doesn't become insolvent and seniors have an across-the-board benefit cut. But within our actual budget, the healthcare industry is the place to start. There's so much waste and inefficiency, as we all know from the delivery of benefits, that anybody who's willing to tackle that and push back on some very powerful interest groups could find a lot of savings.
Well, maybe we'll get that in an RFK Jr. who has been very staunchly opposed to some of the big corporate spending. I mean, Maya, you seem a little skeptical of that. Let me just give you a chance to respond.
No, I mean, I think that you also have to make sure that your actual priorities are the right ones. And I don't know what his priorities will be, but I wouldn't say you just want to cut things without the sound policy base of what the overall government's objectives are. National security, keeping people safe, sound regulations, question which ones make sense and which ones don't. And so you start with the objectives, you figure out whether they're national objectives that should be done at the federal government level, you figure out the best ways to achieve them, you weigh the pros and cons, you don't pretend that everything is easy because it's not, and then you make some of the trade-offs. So I think that's what's going to be really important in this overall commission. Not simple answers, not it's easy, but like we have to start grappling with some of the more difficult things.
Maya, appreciate your time. As always, it's good to see you. Maya McGuinness there of the Committee for a Responsible Federal Budget. I hope Maya's not listening. Isaac Boltanski of BTIG putting a number on what he's expecting. Our initial read of the landscape is that there will be at least $7 trillion in new spending over a decade with no real clarity on the amount that will be offset.
And this was going to be the trajectory regardless of who won the election, because when you look at the promise on the campaign trail, of course, not all of them are policy, but you look at where the direction of travel was going for the Republican Party and the Democratic Party, there was going to, of course, be higher fiscal spending.
Isaac Boltanski joining us in about an hour from now. Look out for that conversation. Coming up on the program, President Biden preparing to meet with Chinese President Xi Jinping tomorrow. We'll discuss with Bloomberg's Enda Curran from New York City. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Heading towards a week of losses here on the S&P 500. We're down again this Friday morning, and good morning to you. We're down 0.5% on the S&P. On the Nasdaq 100, we're down by 0.75%. On the S&P, this, of course, follows the biggest weekly gain of the year so far, just last week when we had the US presidential election. This market's been quite difficult to sell for many of you. Michael Hartner of Bank of America this morning, sell hubris and you buy humiliation. Let's see how this one works out. In the bond market, 2-year, 10-year, 30-year, looks a little something like this. 2-year yields are down by 2 or 3 basis points to 4.3181. But on the week, still higher on the week, advancing for a 4th consecutive week. The longest such streak going back to April. We've just had this drip feed of data. CPI, PPI, jobless claims, retail sales later, eroding the perceived easing bias of the Federal Reserve.
It is yet again the pendulum has swung. One could argue that heading into the last meeting from the Fed, that we just got too over our skis with cuts. And then you get all this good data come in, and then the bond market needs to recalibrate, and then you get the US election, and then we need to recalibrate again. And what you have in effect is a market that's running away from the Fed, that wants to cut, yet it is a bond market that keeps pushing yields higher.
That move in bond yields, of course, reviving that dollar story once again. 5 days of euro weakness into Friday, just a little bit of euro strength this morning. Euro dollar at the moment shaping up as follows. We're trading at 105.77, we're up by 0.5%. The first day of euro strength going all the way back to last Thursday, a week ago. Under surveillance this morning, traders dialing back expectations for a December rate cut after Fed Chair Jay Powell signaled he's in no rush to lower rates further.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
And just like that, December now feels like a bit of a coin flip going into December.
Right. It feels like it's almost going to be potentially off the table, depending on what the next few data prints show us, which is why things like retail sales today is going to be important. Also, this idea of, and you both have been talking about this, optionality. They want to have options. And I just wonder how much they want to have options now because we have the outcome of the U.S. presidential election and the policies that might be on tap for 2025 could be inflationary.
I actually think this December meeting is going to be so interesting in regards to the politics, but maybe not the way most people are saying. If he pauses in December, how is that going to look to Donald Trump? That he cut right before the election by 75 basis points, and then right before Trump starts his term, he pauses. I mean, I don't know what that ire would do to Trump, whether he can do anything about it, but it could definitely stoke some tensions.
There will be truth socials by the storm if that happens. And actually, I was on the phone with someone when these headlines dropped yesterday during Powell's speech, and that was the conversation. You cut twice before the election, but now I'm about to come into power. I'm about to get inaugurated. You know I want lower interest rates, and you decide now is the time to hit pause. They're going to say it's political.
I agree with you both. December is going to be a fascinating Federal Reserve meeting. It's only about a month away. Let's talk about this story as well. It's been a busy 24 hours in markets. Reuters reporting President-elect Donald Trump plans to end the EV tax credit. Shares of Tesla and Rivian under pressure temperature after the report, with sources telling Reuters Tesla representatives support the decision.
Yeah, Musk was posting on Twitter that the U.S. should, quote, end all subsidies, including those for TVs, oils, and gas. So he doesn't want subsidies in the market. And Danny, I know you're going to talk about the fact that actually this might help him. I looked at this report and I said, NSS, why are people at this moment deciding to sell these shares when Republicans have been talking about this literally for months? So you would have thought that the second that you saw that we were going to get this trifecta, that you would have saw this hit the stock market, because this was already in the cards.
Right. And look, you saw in the reaction to the stocks, both Rivian and Tesla fell, but one of them fell a whole heck of a lot more than the other, and that's Rivian. I was just looking at these numbers. You have to figure only one of these companies can survive without subsidies. For every car that Rivian makes, they lose about $40,000. In the short term, sure, may be painful for both companies, but in the long term, Tesla is the clear winner from this, and maybe it clears out some of the competition.
Tesla turning positive in the pre-market. That stock is up now by about 0.25%. Let's talk about China. China's economy showing signs of balance in the fourth quarter. October data from the National Bureau of Statistics showing consumption growth nearly catching up to factory output. Retail sales expanding at the fastest pace in 8 months. And this is what many investors were positioning for, Danny. They want to see a whole lot more than just this.
I'm curious to know how much of this is temporary, because we have to remember late in September, China basically unleashed a lot of policy, and the net impact of that was a stock market that went through the roof, up some 20% in September alone. So how much of this is just a one-off? How much of this is just a one-off sentiment boost after that versus a China that not only needs to respond to keep that, but needs to give more stimulus, given what type of policies we might see from the Trump administration?
Could see some major tariffs in the next few months coming from the Trump administration. President Biden and Chinese President Xi Jinping is meeting in Peru on Saturday. Biden said to focus on maintaining stability as the relationship transitions into the Trump administration's hands. Bloomberg's Ender Curran joins us now for more. Ender, good morning to you, sir. Can you frame this meeting? What is this going to look like over the weekend?
It's really something of an exit interview for outgoing President Biden. You know, taking stock exercise. If you think where we were a year ago, John, when APEC was over in San Francisco, that was a big meeting between both leaders. They set out new channels for military-to-military communications. They reopened cooperation, say, on AI and on narcotics control. And, of course, the Biden administration will say there's been progress on those fronts. But today's meeting will be nothing like that. President Biden, as we all know, is the lame duck. He's heading out the door. And not only that, President Xi will be sitting there looking right through this meeting, knowing that there's a very different administration coming in a couple of months now, not just on the trade front, but on the security front. We've seen some of the names being appointed to the cabinet, very hawkish when it comes to the China side of things. So, you know, it's a stock-taking exercise. It's a farewell between these two leaders who've met many times over the years, but hard to see anything major coming out of it, or hard to see anything in terms of a new direction coming out of this meeting.
Well, Ender, let's talk about the transition and the change, and let's talk about the difference in approach. Donald Trump is far more forceful, much more blunt. Joe Biden has claimed to be far more nuanced and much more targeted. Now, Ender, when I look at the Biden approach to China, I have to say, we've got to highlight a failure to influence Chinese policy over the last 4 years. Is that going to change under Donald Trump?
Well, the Biden administration say they pursued, like you mentioned, John, this policy of intense diplomacy, and they say they eked out progress where they could in terms of cooperation, like we said, on AI, for example, or narcotics control. But there have been plenty of critics as well that the China-US story has stalled over the past few years, and that's given plenty of scope and ammunition for President Trump to come in and finish what he started in his first term. And he's highlighted in particular the trade side of things. Now, we don't yet know what President Trump is going to do there in terms of tariffs or other protectionist measures, but we do know two things. There's a lot of support among the business community for measures against cheap Chinese goods or cheap Chinese competition, accusing China of dumping in global markets. But equally, there's a significant business lobby that say tariffs will complicate their business, drive up their costs, and force them to make some fairly significant changes to how they operate. So on the headline basis, there's a case for rebalancing trade with China, but it's very complicated, and I think a lot of people are waiting to see just how this will be executed, because remember, the Biden administration was all about targeted tariffs, whereas it seems to be more broad brush in terms of what the incoming Trump administration is talking about.
And of course, we know the Secretary of State is a China hawk. He's actually been sanctioned by Beijing, but we're still waiting to see where Robert Lighthizer, Ambassador Lighthizer, would go in Trump 2.0. But we heard from Catherine Tai, who's right now the head of the USTR, and she says as an economic matter, as a political matter, a societal matter, no matter who is in charge in the United States, we cannot withstand a China shock 2.0. Is there a lot of distance, Enda, between a Catherine Tai and a Robert Lighthizer?
No, well, as you know well, there's been such a convergence on both sides of politics over the past decade when it comes to the China story. It's broadly speaking now the bipartisan hawkish view, whereas at the very least China is a strategic competitor. There needs to be measures taken to both boost and protect US industry. I mean, there's agreement on that. There's less agreement on how to do that. And let's not forget the global backdrop. The US officials down at APEC and at G20 next week, there's going to be plenty of pushback and plenty of messaging to Washington about the potential damaging effects from what's going to be happening over the coming years when it comes to tariffs. We've already had the Vietnam president making the point that tariffs and protectionism lead to recession, poverty and conflict, a very striking warning. You've had President Macron over the past few days warning about the prospects of a new trade war. So yes, the US can make its case that it needs to do more to protect its own industries, but it really has to sell that message in the global stage too.
When it comes to this exit interview, as you called it, not to be rude, but it almost feels like a waste of Xi Jinping's time, especially given the raw political power in the foreign policy space we've already seen the president-elect draw. But in these final months, is there something China and the United States could work on before Trump gets into the Oval Office?
I mean, as Jake Sullivan briefed reporters on, it's all about just maintaining that stability and consistency over the transition period and getting across the message that it's both interests of both governments to keep that going into the next administration. But as we all know, this administration does not speak for the new one that will take over in January. They have a much more hawkish outlook on how to go about the China policy and what they're going to execute and which buttons they're going to push. And China knows that. They just don't know what exactly is coming down the pipe, and that's why they're waiting. They're waiting in terms of how much support they're going to put into their own economy, and they're waiting to see how they will respond until they get specifics. So to your point, and there won't be much new coming out of the meeting between President Biden and Xi, because we all know in January going forward, it will be a very different story.
On the point of China holding back, Enda, how much firepower are they holding back to support a domestic economy if it is more hit by policies coming out of a new White House?
I think it's fairly clear that they are holding back at the moment, Danny. They have significant room to spend more money at the central government level if they need to. They can even go and they don't have to borrow in global markets, but you saw the huge response to that Chinese US dollar bond this week, for example. I think they want to wait and see how the tariffs play out, which sectors will be impacted, and then they will respond by putting more money into the economy. They're keeping things ticking over at the moment. You saw the retail sales overnight. That's a little bit of a bump up there, heading in the right direction. If they can get growth to around that 5% target for this year, they'll probably take that. But there's no doubt that, you know, if we're in a trade war, full-blown trade war 6 months from now, China will be forced to respond, and they'll have to respond forcefully on the ground in China too.
And how should we be thinking about some of China's international investments? After the first Trump administration, you saw China move out. They moved a lot into Mexico, something that Trump has specifically said that he will target. What could be the potential impact there of their investments in emerging markets, especially in LATAM?
There has been a big reshuffling of Chinese investment around the world and global investment. Remember, China used to be the go-to place to put your factory into, say, up to a decade ago. Now, companies have been shuffling production around the world to escape those US tariffs. But to your point, the US trade policy is wising up to that, and they're starting to track where Chinese products, Chinese components might be coming out of China, going via third parties and into the US. So it might make that trade story more complicated. It might make the trade diversion out of China story more complicated if it's more of a universal tariff that the US is implementing, for example. And of course, we have to, again, wait for specifics to see what the Trump administration does, whether or not they, on paper, they're saying they will not welcome Chinese investment into the US. We'll have to see if that changes over time. But if we are in a trade war, a few months from now involving tariffs and export restrictions and other investment controls, there's no doubt that will make both investing in China more complicated and make doing business with Chinese companies in other countries more complicated too.
Enda, thank you, sir. Always fantastic to catch up with you as well. Enda Karen there of Bloomberg. Out of Washington, D.C. on the latest, who is at the top of the naughty list? Is it China? Is it Mexico? Or is it Europe? We caught up with Rob Casey in the last few days of Signum. And Signum are basically saying it's going to be Europe, Anne-Marie. That's top of the pile for them.
And they're preparing on what they could do when it comes to tariffs on Europe. But potentially this is going to be broad strokes. They're going to move quickly on Europe, on China, and looking at some of the factories that the Chinese are opening up in Mexico all at once.
Pricing in the good stuff, aren't we? Deregulation. We were talking about the M&A boom with Morgan Stanley earlier on this morning. The prospect of tax cuts. Then the sequencing shifts towards tariffs. That's going to be the focus into the new year.
It is, because the tariffs are the things that could come sooner. To Anne-Marie's point, it's the one that you can enact. And I wonder if this market can keep looking through it, because at the moment it is pricing it in that we're not going to have sweeping tariffs, that maybe it'll be one-offs. It will try to be to stoke more competition internally. How long can that last with a market, again, that might not get the tax cuts and deregulation that it wants until over a year from now?
Stocks right now negative by 0.5% with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Pool Corp and Domino's Pizza are moving higher in the pre-market after Berkshire Hathaway bought shares of both companies in the third quarter. That's according to a regulatory filing. The conglomerate also shedding most of its Ulta Beauty holdings, sending the retailer's stock down in the pre-market. Meanwhile, President-elect Donald Trump continues to fill out his cabinet, Trump saying he's tapping Robert F. Kennedy Jr. to run the Department of Health and Human Services. That puts the prominent vaccine skeptic atop a massive agency overseeing everything from food, vaccines, and medicine. Meanwhile, Trump has chosen Doug Burgum, the governor of North Dakota, to be the next Interior Secretary. The position will give Burgum a significant influence over plans to boost domestic energy production. Both picks will need to be confirmed by the Senate. And with Trump picking RFK Jr. to lead the Department of Health and Human Services, shares of vaccine makers, including Pfizer and Moderna, are falling in the pre-market. Trump saying that RFK Jr. will help take on the health crisis in the country and make America great and healthy again. That's your Bloomberg Brief. John?
Yahara, thank you. I think we've all seen exhaustive coverage of the vaccine story. Not enough on the food story. How will this individual work with the USDA? How will he really go to fight with the food lobby as well? It's the food companies, for me, that just take on a little bit more interest, given that everyone else is focused on the other stuff.
Well, when you hear what some senators have to say, it's the fact that he has been critical of the additives that are in American food, and that's what they like about him.
Yeah.
But then they say, not quite sure if we want him in charge of vaccine policy, though.
He's got some really valid points when it comes to nutrition, and I just wonder what that fight would look like if he can get confirmed. Up next on the program, looming Trump tariffs.
Any company that has not already started to move at least some of their production to other regions of the world is probably either in denial or they may not have a risk mitigation and security strategy that they probably should be having in place.
A conversation up next, live from New York. This is Bloomberg.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
As we work our way towards the weekend, here's a snapshot of the price action. Equity futures right now down by 0.5%. Bond yields just about unchanged. The 10-year 443.74. Under surveillance this morning, looming Trump tariffs.
Any company that has not already started to move at least some of their production to other regions of the world is probably either in denial or they may not have a risk mitigation and security strategy that they probably should be having in place. It's hard to know what exactly the impact is going to be, the timing of the impact, and even which products are going to be affected.
So here's the latest this morning. Retailers reporting over the next week, facing down the prospect of higher tariffs and a shortened holiday shopping period. Greg Mellick of Evercore ISI remaining optimistic. Election clarity is hopefully a cheap form of stimulus. Trump tariffs and tax cuts should prove neutral to positive. Greg joins us now for more. Greg, before we get into holiday shopping and the consumption boom we might see over the next few months, can we just talk about how these retailers might manage inventory between now and inauguration of President-elect Donald Trump, whether we're going to see these massive imports come from China, whether that's already started to get ahead of those tariffs?
Yeah, I don't think there's any surge ahead of tariffs. For a lot of large retailers and even smaller ones, we went through this a few years ago, so they have a playbook as to what they're going to need to do ahead of those sort of shifts. And I guess what I would say is right now they're still dealing with remembering very recently the problems we have at the ports on the West Coast a few years ago and getting that inventory in time. So I think they're being cautious in terms of how much inventory they bring in early or quick ahead of some theoretical tariff change, which will be very basically country and product specific probably at the end of the day.
Greg, how much more resilient are those supply chains now? Have they diverted traffic away from China? Is it going through somewhere else, away from Mexico? What are the big changes that you can identify?
It's a great question. I think from if we go back to pre the tariffs, so it's like back 2017, 2018, it looks like what retailers are bringing in from China is down probably 25 to 30%. A lot of that hasn't moved back to the U.S. It's moved to Mexico. It's moved to Vietnam. It's moved to India. So there's been a broadening out of the global supply chain. And this will probably further accelerate that trend. To go to where products can come in with higher quality at a lower cost. And there might even be some reshoring as well, or nearshoring, that has been part of the trend, but not the major movement.
Greg, the date I want to know about, not Trump's inauguration, but January 15th. That's when the deadline for the Longshoremen Association expires, and they need to come up with a new deal. What is the risk that we have a repeat or something worse than we did in months prior, especially with the new administration that's, for all accounts, less friendly to unions?
Look, that's a great question. And frankly, I'm glad you brought it up, because as we talk to retailers and vendors, we're finding that date, hopefully it'll get sorted, but that's still a very real and relevant date without any theoretical tariff changes in the future. So making sure that we have the products that we need if there is a disruption and if a final deal isn't signed by then is important. So look, there's a lot of moving pieces. And that's why I would say, even though we think the consumer's in a better spot and will be slightly better into next year, it's certainly not a V-shaped recovery by any stretch of the imagination.
Let's talk about that better spot for the short term. What do you anticipate the holiday season demand to look like?
We're looking for retail sales to settle out at this 3 to 3.5% nominal growth rate. We'll get October numbers later today, which we think will be in that range. And the things we're watching, it's really the categories that we think are starting to have rolling recoveries. We think home improvement is one that after 14 quarters of negative traffic at Home Depot and Lowe's, that's a category that will start to turn positive next year. Maybe not by first quarter, but certainly later in the year, because our home improvement lead indicator has had a pretty sharp acceleration the last 6 months.
Ahead of the holiday period, though, I'm looking at names like Target, Walmart, Amazon, when people are going to potentially go and buy some of these big ticket Christmas items. Who do you think is going to fare the best?
You know, I think it's the trend that we've seen all this year continues. The consumer is willing to spend, but they're very cautious and value focused, and they want to see newness. And what we've seen from that is Amazon, Walmart, and Costco so far have combined for 70% of retail dollar growth this year. So retail sales are up a little over 3%. If you X out those three retailers, retail sales are growing 1%. So I think for a lot of the other ones, it's really catching the right trend, having the right product, having the newness, making sure you lean into value. That's how some of those other retailers could hold through this. But I think those three, Amazon, Costco, and Walmart, are in a very good spot.
Apparently there's 5 fewer holiday shopping days when it comes to this season. Do you think that's going to affect the outlook?
Yes, I have the gray hair to remember when this had a bigger impact. I think that e-commerce growth to now 22-23% of U.S. retail sales has changed it, and maybe it's a little less of an impact because there's more flexibility in how people shop and acquire goods for holiday. But at the end of the day, I would say it might be 50 bips of pressure, all else equal, just because there's fewer days between Thanksgiving and Christmas to get stuff done.
They're trying to add days. Trust me, Greg. We went to Bloomingdale's day after Halloween. Straight away, Christmas music. Didn't stop, did they?
Jingle bells. It was ridiculous.
Greg, thank you, sir.
We had to get ready for it. Yeah.
Appreciate your time. Let's catch up again soon. Greg Malik there of Evercore. Just as we're talking about tariffs, new op-ed coming out from Scott Bessent. Scott Bessent, of course, a leading candidate to be the next Treasury Secretary under President-elect Donald Trump. This op-ed in Fox News this morning, and here's a key paragraph for you. The truth is that tariffs have a long and storied history as both a revenue-raising tool and a way of protecting strategically important industries in the United States. President-elect Donald Trump has added a third leg to the stool, tariffs as a negotiating tool with our trading partners.
This has been some of the criticism of whether or not Donald Trump was going to appoint him as Treasury Secretary. Was he not as forthright, and was he not as excited about using tariffs? I think putting this op-ed squarely in Fox News, he is making the case that I am on board with the tariff regime when you come into office.
It's in Fox News this morning on the website, Scott Bessent. Let's talk about tariffs. It's time to revitalize Alexander Hamilton's favorite tool. Up next on the program, in the second hour of Bloomberg Surveillance, we'll catch up with Phil Camporelli of JP Morgan Asset Management. We'll speak to Isaac Boltanski of BTIG, who puts a number on the Republican effort over the next 12 months. The tax cuts, all of that. He's talking $7 trillion. $7 trillion worth. We'll break down what's behind that $7 trillion a little bit later in the program. We'll speak to Bloomberg's Trade Rudell on the future of automakers, and we'll catch up with Michael Kushner of Morgan Stanley following those comments from Chairman Powell just yesterday. Equity futures on the S&P 500 right now negative by 0.5%. In the bond market, 10-year yields are just about unchanged at 4.43. Your 2 years down 3 basis points to 4.32. From New York, this is Bloomberg.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system
We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The range of outcomes as we move into next year is going to be wider. If the earning trends for the market are still moving higher, so I think that's positive.
The thing that you have to respect in the market right now is the momentum and just the optimism surrounding growth for 2025.
Before you jump immediately to what's going to happen next, understand that you got to wait because it's really complicated economics sorting all this out.
Trump doesn't take office until January. A lot of the initial policy moves may take 2 or 3 months to fully play out.
It's time to watch and let the policy take effect and see what happens.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Retail sales in America are about 90 minutes away. Going into that, equity futures on the S&P 500 down across the board here on the S&P, on the Nasdaq too. On the S&P 500, we're down by 0.5%. On the Nasdaq 100, we're down by 0.8%. Chairman Powell in the last 24 hours really shaking up this market with this quote right here. The economy is not sending any signals that we need to be in a hurry to lower interest rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully.
And back in August, he said the time has come to adjust policy. This is a different sounding Powell. Not only is inflation stubbornly high, but it is a labor market, we saw it with jobless claims yesterday, that continues to be strong. It's far from falling apart, and I think in retrospect, it's maybe a market that's asking, did we get over our skis in all of the cuts that we've been pricing?
He talked about the fact that this will also depend on incoming data. We already knew that, but then he said, and the economic outlook evolving. Well, it's going to evolve quite significantly in 2025 if some of those promises on the campaign trail from Donald Trump actually come to fruition with his trifecta in Washington, D.C.
We could see some major changes right now in the equity market. That rally does stall. Equities are down across the board. We're near session lows. We're down by 0.5%. In the bond market, we've had some big moves at the front end of the yield curve. We're heading towards a fourth weekly gain for a 2-year yield. The 2-year this morning, Danny, is down about 3 basis points at 431, but on the week, it's up again.
It is up again, and it's shaping up actually to be the front end of the curve that's more interesting. After the election, it had been the long end, it had been the fiscal concerns. That seems to be put to the side. Again, concerning ourselves with what's happening with these rate decisions. I do think in the long term, though, it was really interesting to hear Powell talk about tariffs and said his concern is growth. It's not inflation. He's concerned that it's going to hamper growth at a time when they're trying to reinvigorate it. So he actually might be fighting a different battle than we've been talking about.
Which is why retail sales is so much more important at 8:30. 9:30 Eastern Time to get a read on the US consumer. Coming up this hour, we'll catch up with Phil Camporelli of JP Morgan as the post-election rally runs out of steam, Isaac Boltanski of BTIG as President-elect Donald Trump unveils more cabinet picks, and Bloomberg's Craig Trudell on the future of EV tax credits. We begin this hour with stocks lower and heading towards a week of losses following Fed Chair Jay Powell's hawkish comments, saying the FOMC is in no rush to cut rates again. Phil Camporelli of JP Morgan saying the pace of easing
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Alpha trade of out yielding our index in a world where the fundamental story continues to support high yield.
Well, usually one trade that works pretty well is the more credit spreads tighten, the better risk assets as a whole do. If there's just less room now for credit spreads to tighten, does that put any ceiling on risk overall, or just the correlation's all out of whack considering how tight things have gotten?
Yeah, so that's a good point. I think it's a whole story, Danny, of macro volatility coming down. I could make, this might not get the best ratings, but I can make the case that uncertainty is actually less now, not more, post